Welcome to the Bitcoin Layer. I'm Nick Bhatia. Despite it being 15 years old, Bitcoin is still widely misunderstood. In September of 2024, I had the honor and pleasure of sitting down with legendary financial researcher Michael Howell to teach him about what makes Bitcoin so special. Please enjoy this 3-part series in which we go through the history of Bitcoin, a cryptography history, how Bitcoin's blockchain works, what Bitcoin mining is, comparing Bitcoin to gold, is Bitcoin an asset or a currency, and much, much more. And don't forget to check us out at thebitcoinlayer.com/subscribe for our free research publication. Michael, it's great to see you.
Nick, great to be here. I'm looking forward to this very much. So let's go for it.
So the premise behind the conversation, Michael, was that you and I were chatting about Bitcoin, about global markets, about our frameworks. And you asked me a question that made me understand you hadn't understood yet Bitcoin mining and what that process was, preventing you from understanding what makes Bitcoin so unique in comparison to other cryptocurrencies. So our goal today is to really teach you Bitcoin mining. That's the end goal, because I think when you understand Bitcoin mining, the light bulb will go on and you will understand why Bitcoin itself is the special thing. So what are your thoughts before we get in here?
Well, I think my thoughts are that if you take it from the standpoint of, let's say, monetary economics, two of the critical questions to ask, or two of the critical laws to try and understand, one is Gresham's law, which is bad money drives out good from circulation. So I wonder to what extent Bitcoin, if Bitcoin is money or a form of money, that law, which has existed for centuries, applies, and how can we craft application of that. And I think the second question, which is a connected thought again from monetary economics, is where does Triffin's dilemma, which is another rule, where does that fit in? And Triffin's dilemma, as one remembers, was applied to the US dollar, particularly in the early 1970s, when there was a conflict between the elasticity of credit money and the limited supply of commodity money, that being gold. So effectively the dollar, or the federal deficits, the US deficits, were compromising the gold backing of the US dollar. And Nixon, as we recall, in August 71, cut the dollar free from gold. So I think those questions are very important questions in monetary economics, and it would certainly help my understanding of the role of Bitcoin to see how Bitcoin fits in, or whether it bends those laws, or whether it satisfies those laws.
The Bitcoin Layer is sponsored by Unchained, the undisputed leader in Bitcoin financial services. Unchained empowers you to take full control of your Bitcoin with collaborative multi-sig vaults, in which you own 2 of 3 keys and you gain a Bitcoin security partner. You can purchase Bitcoin directly into your cold storage via Unchained's trading desk and eliminate all exchange risks. Unchained also offers the best IRA in the industry, where you can convert your existing 401ks or retirement accounts to Unchained, all while keeping control of your Bitcoin private keys. Don't pay more in taxes than you have to. Talk to Unchained today. Go to unchained.com/TBL for $100 off when you sign up. Don't risk your Bitcoin security. Do you have Bitcoin private keys stored on paper? Make sure you convert those keys to titanium with Stampseed. Stampseed has this really cool DIY kit that allows you to hammer in your seed phrase into these small titanium plates that are fire resistant and damage resistant. This kit is designed by titanium metal workers that have been working in stamping metal for over 14 years, and your words are deeply stamped, not just a shallow dot. So make sure you check out stampseed.com today and use code TBL for 15% off of your order. The first question that you have about good money, we will definitely be working towards answering in this lecture. And by the way, guys, this probably will go over multiple parts because we can't just teach Bitcoin in an hour. That's not how it works. We really want to explain Bitcoin mining. The second question, which is about Triffin's dilemma, about the global monetary system and how Bitcoin fits in, that'll be a longer conversation, Michael, because I think that once you see Bitcoin for what it is, we can explore the future of the financial system, specifically the coexistence of a credit system and good money. And they don't have to be denominated in the same thing anymore. And that's, I think, the goal of the takeaway, but we'll get there. Okay, so what we are going to do for everyone at home is we are going to have a presentation up here. And this presentation is one that I teach to my students at USC Marshall School of Business. And the reason that I wanted to bring that slide deck to Michael is because it's the way I'm familiar and comfortable teaching Bitcoin. So we're going to just lay it out and give us time, Michael, to get to Bitcoin mining, because we might not even get to it in this first hour. But we'll work our way towards that with some definitions and some groundwork. Now, the three core tenets of Bitcoin for this lecture to understand where are we going and what is Bitcoin. Number one, Bitcoin is an internet protocol. So that is the first definition, Michael. It's not that Bitcoin is money. That's really second. But first is that it's an internet protocol. So we're going to attempt to understand Bitcoin as a protocol before we can understand the money within that protocol, because they're both named Bitcoin. So Bitcoin is the name of the protocol, the name of the software, the name of the idea, and the name of the research paper. Those are all called Bitcoin. Within that software, there's a unit. There's a unit of account. It is also now called Bitcoin. So that's why we say the price of one Bitcoin is 60,000 US dollars. That is 1.00000 Bitcoin within the Bitcoin protocol software. Okay, that's the first thing. So Bitcoin is an internet protocol. The second thing is that Bitcoin is property. So the unit of account within the protocol can be looked at as property. Now, the reason that it's property, Michael, and not an entry or an account with a company or a login, that it's more similar to a physical key in your hand, a single metal key, because the key that you hold is actually a number. It's a scarce number. It's your own number, but it's a number that no one else knows. No one else knows it, and it's mathematically improbable to guess it. We're going to get more into that mathematical improbability today because it's the foundation of Bitcoin, and it's actually the foundation of cryptography, not just Bitcoin. Bitcoin came after cryptography. So the third tenet of Bitcoin is that Bitcoin is money. So it's that key, it's that number. It's money without financial institutions. So you don't need FedWire. And for everyone at home, I'm going to speak Michael's language. Michael is let's just call it what it is. He's a legend of finance. So he has several decades of experience at the top of the financial world. I mean, just in terms of his knowledge and his background. So we're going to talk to him as if he is who he is, which is someone completely versed in all the financial terms. But we're going to round out his knowledge from the Bitcoin side.
If you asked this a slightly different way and you said, what is an asset? And then the next question is Bitcoin an asset? I would find that maybe an easier concept initially to understand. And
Absolutely.
what I would say is if you look at the criteria for deciding on an asset, I would list maybe 4 or 5 different characteristics. One is ownership or proof of ownership, which I guess is your second bullet here. The second dimension is that the asset has got to hold value in some way. Okay. So, in other words, you've got to have some notion that value is predictable. It's not going to, your asset is not going to suddenly melt away, disappear, evaporate, or whatever. You're going to have it tomorrow, and it's going to be largely the same amount that you had, at least the same amount that you have today. So that's, if you like, a scarcity durability question. Okay. The third factor I would say is that you've got to have transferability of the asset. In other words, if you want somebody else wants it to recognize the value, you need to transfer that, and you need to transfer that in an easy and cheap manner. Okay. And I guess Bitcoin, because it's an internet protocol, facilitates that point. The fourth point I would say is that you need acceptability. So, in other words, people have to recognize, like you, that there's value in this thing. And probably, this is the getting towards the grey area of whether this is an asset or whether it's money per se, is it needs to be acceptable for settling debts. Okay. Now, you can settle debts with an asset, but the point about money is that money gives you instant settlement and it's good for government taxes, federal taxes. So you can't settle federal taxes with a different currency, and you can't settle federal taxes by transferring an asset. You've got to effectively have money, and that's one of the key factors. And those 5 or 4 or 5 aspects are really what I would say constitutes an asset, and maybe a sort of the fifth point is an extra dimension, which is saying this is really what makes that asset money. It's liquid, it's good for settlement, it can give you immediate settlement, etc. Now, if you have those 4 or 5 criteria, then is Bitcoin an asset, and could it be money? And that's really, I think, a critical question. Or maybe another point is to say, does it really need to be money? Gold isn't really money, but gold's a very liquid asset. And maybe that's enough. So those are the sort of questions that I would kind of raise. And that doesn't necessarily interfere with a lot of the use values of Bitcoin. And those use values could be significant, and they could propel the value of Bitcoin, dramatically higher, as we know. But in terms of the first page, I would say, does it tick the boxes for being an asset? So over to you. I guess it does.
Yes. So let's start with your last question, which is it an asset and is it money? And gold doesn't necessarily have to be money, but it's a liquid asset, which makes it close to money, but maybe not quite. So that's the way I would approach Bitcoin. And I have an example for you about money market funds. But that's the way I would approach Bitcoin. It's definitely an asset. We're going to check all these boxes for you. It's definitely an asset because it definitely satisfies these properties these characteristics that you laid out. The acceptability for debt settlement, I'm going to get into the nuance there. But the acceptability for debt settlement and the question whether it's money or not are similar in that the answer to is it an asset is yes for both. And even if the answer is not necessarily yes to the money part, it's so close to money and exceeds other monies in some of the other characteristics to the point where it satisfies a monetary criteria to the extent that it is a new technology and is breaking into the sphere as an internet protocol. There's never been an internet protocol that's also a money. So which makes Bitcoin unique. So ownership, yes, without any, or let's just say categorically, yes, there's ownership proof because of the way that the protocol is designed and the cryptography that underpins the protocol. It's mathematics, it's improbability, it's statistics. So we'll get into those things. So yes, value, you know the answer as well as I do, that Bitcoin has a price. It's been recognized with a price for over, a dozen years. Quite liquid for the last, I would say, 8 years, financialized with options and derivatives for the last 7-8 years. CME was 2017, Michael, for the futures contract there. So going back 7 years, and a price that is, I would say, arguably liquid in 100 countries around the world and 100 currencies, so not just USD, making it uniquely liquid. Even gold doesn't have that type of instant pricing mechanism, not even close. Gold has, there's always a market maker for gold in every city that you go to on the planet, right? There's always a shop that you can go into and get cash paper for your metal, always. But that price that you get, how close is it to spot? And in your currency, it's going to be highly varied and not nearly as transparent as Bitcoin. So gold is going to be the benchmark here for a lot of this. Transferability, you nailed it with the internet protocol. It's categorical again there, that it's transferable, especially with when you combine it with the liquidity and the value recognition. The transferability is key, because if you can't send it to the exchange in a few minutes, it's not really liquid. So the fact that you can send it to the exchange, sell it for dollars, and transfer those dollars back to your bank account within hours or a day, if you're in your domestic currency and you're using a good and able exchange and a good and able bank, it shouldn't take you more than 24 hours to turn your actual key into a commercial bank deposit. And so that timing, now I want to bring up the acceptability for debt settlement, because how acceptable for taxes or for debt settlement would you argue a money market fund is, shares in a money market fund? So if you owe $1 million in taxes and you have $1 million USD sitting in your brokerage account, but it's not in stocks, it's in a money market fund, would you argue that that is money, Michael? It's an asset, obviously, but is it money? Can it be acceptable for debt settlement?
Well, to the extent that if it's underwritten by the state, I mean, this is where it comes back to finessing the definition of money. That money basically is something which is acceptable for settlement of taxes approved by the states. So, in other words, if you're looking at a money market fund, you're running some counterparty risk with a money market fund. If that money market fund gets into trouble, do they break the buck, for example? Is the Federal Reserve likely to come in and back that money market fund? Now, that's not really within their remit, but there are circumstances where that may occur. So, if you're looking at a regulated high street bank, that is more likely to be pure money, because the state, the US Federal Reserve, is underwriting your deposits in that bank. So, in other words, a money market fund is extremely close, but we're looking here at a spectrum or continuum of liquidity or liquid assets. So it's extremely close, but maybe not 100%. A bank deposit in JPM or Citigroup or whatever is much more likely to be 100% money.
And would you agree with me that one of the main logistical hurdles of a money market fund being money is the fact that if you put in your withdraw notice today, the money market fund has until tomorrow to make the funds available. So they sell securities today in the market to make them settle tomorrow, T+1, so that the cash is available for a withdrawal. So it's actually it's almost a timing thing from a money market standpoint, whether or not it's money. Yes, it's arguably money because it's money the next day available for transfer to the IRS, because you can't transfer the share. but you can send a wire deposit and it might take T+1. So I would argue, obviously not from a price stability standpoint or value stability, meaning par today is par tomorrow on a money market fund. That's not the case with Bitcoin. It's highly volatile. But on a T+1 for taxes or debt settlement, I would argue it's very good now. I mean, it's extremely developed and highly financialized to the point where there's almost no difference as long as you have the able and willing exchanges and banks, and that's not the case in every country in the world. But then again, it's not the case in every country of the world that you think you can just have the deposit, which is considered money, because their currency might not have that stability either. So that's the way I would argue yes to the acceptability for debt settlement is using that money market fund as your context. And then your last question about the liquidity profile and the dimensions of Bitcoin. I mean, that's what we're going to unpack here, and what you'll have to answer and keep asking me follow up. So, how do we feel about those answers?
I think they're all pretty good. I mean, the one that which you highlighted about the volatility in the price is clearly something one's got to address. Clearly, with a money market fund, you know pretty much that you're going to get if you redeem $100 today, you're going to get $100 tomorrow. With Bitcoin, it's not maybe as straightforward as that because you have there's a lot more price volatility. But notwithstanding, if you believe that in the longer term, Bitcoin is going to appreciate in value, is more likely to go up than not, then it ticks the box for being an asset that will hold its value in the medium term. And that's broadly how I see it. That's my attraction, or the magnetic force that drew me to Bitcoin, is that I think it is or has served to be a wonderful monetary inflation hedge. So if the US government decides it's going to run big deficits and monetizes those deficits and basically devalues credit money in the dollar, then Bitcoin seems to hold up pretty well. It's outpaced gold over the period, and although it's volatile, it's certainly an asset with clear value. Let's say.
And the volatility has to be explained by understanding the terminal value first, which is a little maybe backwards to some people, but here's what I mean. If gold is our best historical context for Bitcoin, because it's a monetary instrument that is universally accepted and recognized without having to explain securities laws or language, it's numbers. So anybody can understand it. Just like gold is a metal, it's an element on the periodic table. So chemists understand what gold is. Which is chemistry doesn't have a language, right? You can teach chemistry in any language because it's math, it's chemistry, right? And so Bitcoin as numbers doesn't have to be taught or explained. It's numbers that can be understood by any scientist, right? Any mathematician that is developed in that field, which is called cryptography again, can understand what Bitcoin is because it's just a software that they can see. So if gold is our best context, then gold has to be thought of as the terminal value of Bitcoin in the future. But knowing when gold, which is at 1 trillion today, can get to 17 trillion, Bitcoin, which is at 1 trillion today, knowing when that can get to 17 trillion, which is where gold is, and over that time horizon, will gold still be at 17 trillion? I would argue probably not, that it'll likely be at a higher number, especially because its denominator is fiat. So the terminal value should be how much gold represents as a percentage of wealth globally.
Mm-hmm.
So let's just say, for argument's sake, that high quality assets wealth is somewhere around 170 trillion. It might be more. We know real estate, stocks, bonds, total several hundred trillion. But let's just argue 170 for the math. So you have 170 of total high quality assets in the world. 17 of that is gold. So 153 trillion of stocks, bonds, and real estate, that's considered high quality wealth. 17 trillion gold and 1 trillion Bitcoin. So if gold is 10% of all of that high quality asset, can Bitcoin either take away 5% of gold so that together it's Bitcoin plus gold equals 10%? Or can Bitcoin grab some of the 90 and reduce the amount of stocks, bonds, and real estate that are considered the world's high quality assets, because it's recognized this new thing called Bitcoin to replace some of that 90. So if we get to 5 or 10% of that 170 trillion, that puts Bitcoin from 8 to 17 trillion dollars today. That's 7 to 16 trillion in appreciation in the market cap, which the quick way to do it, Michael, is just times are divided by 20. The market cap of Bitcoin will be the supply will never be more than 21 million. It's about 20 million today. So the quick math is that $50,000 is 1 trillion. A price of 50 is 1 trillion. So 10 trillion is 500K. So 500K would put Bitcoin at 11 trillion and $550,000 price. So if the quick and dirty math of my terminal valuation is that Bitcoin gets to $750,000, right, over a time horizon, going from $1 to 50,000 is obviously going to be volatile, but going from 50 to 750 is going to be just as volatile to the naked eye, and even more, even though statistically it'll probably be less on a realized standard deviation basis. To the naked eye, it'll look extreme, because that means one day you'll wake up and Bitcoin will go from 300 to 220,000 in 48 hours, which is almost double the market cap of Bitcoin today. But you'll see a time potentially where the Bitcoin market cap will go down by the market cap that it is today, $1 trillion. Bitcoin goes from 300 to 250 in a day. Can easily happen.
Yeah, but, I mean, I think
yeah.
I would say you're probably not optimistic enough, because I think that what you're arguing very cogently is that 170 trillion that you suggest, and my figures looking at wealth, financial wealth, and real estate wealth worldwide would be actually probably nearer double that. But keep the math straightforward, and let's say it's 170 trillion as a decent figure. So what you're saying is gold is 17. You said 17 trillion, or
Yes.
17 trillion. So of that, gold is 10% of that figure of wealth. But it could clearly be a lot more, particularly if there's a monetary inflation. And if you look at the pace of monetary inflation, which gold normally keeps pace with, that seems to be running on in the US alone at something like at least 8% per annum, maybe nearer 10% at times, looking at the size of the prospective size of the federal deficit. In other words, monetary inflation is going to move at a clip which is probably 2 to 3 percentage points faster than nominal GDP growth. And that will give you some benchmark against which to value or assess financial assets, because financial assets should be keeping pace with that monetary inflation. The best of those monetary hedges in the long term has been gold. Equities, good quality equities, has been a decent long-term monetary inflation hedge. Prime real estate, residential real estate, another good one. But Bitcoin in the last 5 years has really excelled as an excellent or monetary inflation hedge par excellence. I mean, that's really had a very, very high sensitivity or loading to changes in global liquidity. To give you a benchmark, our estimates would say For gold, it's about 1.5. In other words, every 10% increase in global liquidity leads to about a 15% rise in the gold price. For Bitcoin, historically, and I stress this point historically, in the last 5 years, it's been about 4 to 5 times. So it's been dramatically faster. It's been at least 3 times out of gold. That won't apply in the longer term, but you get the point. It's a highly sensitive asset. So I think that it's not just the fact that gold is going to, the Bitcoin is going to take a bite out of gold share. Gold is going to also take a bite out of other asset shares, and the other assets themselves are going to start to inflate because of monetary inflation. So the outlook, if we're correct on Bitcoin, all of us here I'm talking about, the virtues of Bitcoin are pretty staggering.
Absolutely, we would agree with that. And I would even say to you, Michael, that the reason that we don't spend most of our time on trying to determine that terminal value is because it's already high enough. So I mentioned two numbers today to you, 550,000 and 750,000. But let's just call it a million so that we can go back to the study of what's going on today, how liquidity is affecting things, as is part of what you do and what we're trying to understand as well here at the Bitcoin layer. So just put the terminal value at a million and then come back and do the work on what's going on with the asset class today, what's going on with the monetary system today. We think we understand how it's going to unfold. Like you said, the pace of monetary inflation at 8 to 10%. We believe that's going to hold. So that is what will bring Bitcoin to that terminal value, is the realization that the monetary inflation is outpacing the GDP. And that's at the center to the coming up with those types of terminal values. But it's also why we're not trying to pick 500,000 versus a million. We're just assuming it's high enough that we're trying to understand when we get the next cycle up. We know that it'll hit a ceiling because of fear and greed. Markets always do that, and Bitcoin does that exceptionally well. So we're expecting that a few more times before we get to gold, basically. So let's move forward with the presentation. The next slide is a screenshot from Satoshi Nakamoto's original paper, which was published 3 months before the software protocol was ever sent out to the internet. So he wrote it as an idea, and the idea didn't even have the scarcity mathematics in it. So the fact that there would be 21 million coins, the fact that it would start at 50 coins every block, and that at 210,000 blocks, the reward would shrink to 25 every block. Those specific mathematics were not in this paper. And I think that by itself, that's very interesting, because the paper outlined the cryptography. And now I will explain to you, Michael, why we don't use the word crypto at the Bitcoin layer. The reason we don't use it is because crypto, before Bitcoin, crypto meant cryptography. It was the short form of the word cryptography. So the entire cryptography field, the academic field, which really blossomed after the 70s, when disclosures were made about the NSA and what they were doing with applied cryptography. They were hiring every single cryptography top graduate from every mathematical program around the country. So they had a complete monopoly on the field, on the scientific field of cryptography. That broke down in the 70s and 80s. Then it went crypto. It got popular, where the students at the universities that had the internet were communicating and working on crypto projects. And it was designing cryptography tools like private key cryptography, which underpins Bitcoin. So crypto means cryptography to us. But since the cryptocurrency wave Crypto now means cryptocurrency to the masses, to the world. And we think that that is it's misguided to focus on cryptocurrency. What's important is Bitcoin. And Bitcoin came from cryptography. What is not important is the rest of cryptocurrency, which is called crypto. It may be important to some, it's not important to us. We are global macroeconomic researchers. So in the way that Intel and Nvidia and Apple and Amazon matter for the global economy because they're massive corporations, but they're not global macro things. Like, you might glance at Apple's earnings, Michael, to give you a beat on, I'm sure you read, and when Apple comes out with earnings, I'm sure you read the article. Okay? I'm sure you read the Nvidia articles. Okay?
Agreed. Yeah.
But you don't have a slide on Nvidia in your deck, And when you do a conversation with someone on global liquidity, it's probably not going to come up unless the person asks you, because it's not at the center of your framework. Mm-hmm. So I want to just put that at the beginning here. That's what the word crypto means to the world now, which is cryptocurrency. It's not part of our framework at all. Bitcoin is what matters. Bitcoin is what we focus on because Bitcoin is the global macro asset. Bitcoin is now over 4 times the size of Ethereum, which is second place. And it's basically 10x, 20x, or 50x everything else. So there's nothing in crypto that's relevant to us as global macro players. Okay, so going to the next slide, which is that Bitcoin is a software protocol. The software protocol itself is how Bitcoin must be understood, which is why the rest of crypto doesn't matter. Protocol evolution from the internet history perspective, what happens is that people design protocols, which are rules for computers to talk to each other. Then they argue about those rules, and then they figure it out, and everyone in the world starts to use those rules. The rules get maybe tweaked, or the protocol is improved over time for speed, efficiency, but the core rules of these protocols don't change because it has to be designed in a way that every computer, every software company, every individual, every computer device can use. They have to be universal. So Bitcoin is an internet protocol that is on the same level of universality as TCP/IP, HTTP, email, which is SMTP, and DNS, which is the domain system that we use. It is on that level of, we have decided as a world what we are going to use for the transfer of data. So when we transfer data packets, so the internet, we use TCP/IP. Everyone in the world uses this one protocol, or this pair of protocols that was initially designed as one but was split in the early years because it was the more efficient way to do it. Where the TCP would instruct how the data was sent, and IP was the destination system. So they split these two protocols from one, but that's still what everyone uses. So Bitcoin was a protocol designed to transfer value. We'll unpack what it is that you're transferring, but it was just a system designed for that transfer. And it was a system designed so that every computer in the world could eventually use it. That's the way it was designed. The reason it was designed in that context was that people were trying this, Michael, arguably for 15 years. I would say even 20 years, because DigiCash was in the early 90s. People were trying to figure out a way to decentralize money, but the early attempts still had a crypto system and a bank account. So they were still relying on the rails to wire money. And then the idea came, and Adam Back, who designed a early version of Bitcoin, but it wasn't designed to be a currency. It was designed to be a cryptography tool. Adam Back suggested, hey, we need to do this without a bank account. We need to do it on its own rails. And so that was the mission from the 90s, to try to get a system that didn't need, Michael, the wire system, the banking system, the counterparty risk system. They needed a system that was only the internet and your computer. But how could you do it without a ledger to ensure that double spending wasn't happening? How could people ensure that the money wasn't fake? And this is the example that is one of my favorite examples to explain Bitcoin. You know how you can password protect a PDF?
Yeah.
You can email a PDF, right? A PDF is not scarce. You can maybe password protect it, but still the person with the password can open the PDF, take pictures of it, make a new file, and send it out. You can copy any internet file. You can copy and paste it. But you can't copy and paste Bitcoin. And that is part of what we will try to, that's what makes Bitcoin special. We're going to try to explain that to you, why you can't copy paste Bitcoin, but that's what makes it so special. Is they figured out.
Could there be, for example, a better internet protocol for value transfer that surpasses Bitcoin? Or does Bitcoin, it does the job, so there's no need to, if it ain't broke, don't try and fix it.
It's in a later slide, but the answer to your question is that Bitcoin solves a computer science problem called the Byzantine generals problem.
Mm-hmm.
And once you've solved the problem, you don't have to re-solve it. So nobody is attempting to re-solve the problem. They fixed the problem. The problem has been addressed with Bitcoin, so it works for value transfer. It has amassed the protocol universality that we've discussed, so there's no actual reason to search for a replacement. Combine that with the fact that Bitcoin is 15 years old and the market has tried to find a replacement and failed.
Right.
The reason why crypto isn't a field to us is that while the number 2 has remained for half a decade, numbers 3 through 10 cycle out every few years. So there's basically always another failure to reinvent Bitcoin on the horizon.
So the Byzantine general problem, as I understand it, is one about information sharing. Is that correct?
Absolutely correct.
You're really just ticking boxes. And if you've ticked the appropriate number of boxes for information sharing, then there's no need to reinvent another box or a different type of tick. It works.
That's absolutely correct. And so in this next slide, Bitcoin's prehistory, I'm going to point out, a few things here. So TCP/IP in 1974, the first internet protocol that became a standard, because before that, it was still a military project. The internet was still a military project, and the recipients of the networked computers were on government contract with ARPA. And so in 74, it's when the internet became usable by the masses, because it was now just a protocol. You didn't have to have a government contract and align to the ARPANET. So that is one parallel in terms of the evolution of internet protocols. But another parallel in the evolution of Bitcoin is cryptography. So in 76, you had a paper, New Directions in Cryptography, and what that paper summarized was this idea that we could have a private public key pair where the private key is your secret number. And the equation that turns the private key into the public key can't turn or doesn't turn the public key back into the private key. And so that one-way cryptography, having possession of the private key, if it's unique and not shared, is yours forever. And it's mathematically improbable to guess that same number because it's the mathematics that we use now in Bitcoin is 2 to the 256th power. And so that's why nobody can just go and hack the Coinbase wallet. You can try, but there's a bounty on it, and that bounty is there 24 hours a day. So the size of the bounties of Bitcoin's large addresses proves how resilient the cryptography is, in addition to the cryptography being of NSA origin and still used by militaries around the world. It is the military grade cryptography that Bitcoin is using. The algorithm itself is SHA-2 from the SHA-2 family, which was NSA 2001 published, but likely existed for many, many, many years before that. So going through a little bit of the timeline, one thing I want to flag here is 1989, David Chaum founded DigiCash. So that was the cryptography-based system of currency, but still having ties to the banking system. And that's why it ultimately failed. In 1992, Eric Hughes and Tim May really let's just say that they were at the beginning of the vocal movement towards let's use internet protocols and cryptography tools to protect ourselves against the government, against a government overreach. So an extremely politically motivated cohort of cryptographers led a movement that ended up with Bitcoin. So Bitcoin is a direct descendant of cryptography tools that were designed as protection against government overreach.
Okay.
And you must, yes, yep.
Sorry, let me ask a question just to that point, and it may be a question that you address later, which is probably the obvious question. If you're a government, say you were now on the other side and you're working for the government, how would you stop Bitcoin?
You would have to answer that by asking yourself who would want to stop Bitcoin?
Well, let's say, for example, that it was they were losing tax revenues or they were losing control of the monetary system. And if people are using Bitcoin, they're not using US dollars. Therefore, there may be an incentive to do that. And I just wonder at this stage, is there a clever way of saying, well, okay, we could actually put a brake on any further use of Bitcoin? I mean, they could make it illegal, but then that wouldn't stop people transacting. Is there anything that they could actually put in place that would actually break the Bitcoin movement? And that's an interesting question because I would rather suspect that the answer from what you've just said and looking at this array of data and innovation is no. They can't do anything.
So I would flip your question around a little bit, Michael, here. Okay. I would argue that Bitcoin is very good for the United States as a country. And I would also argue that Bitcoin does not threaten governments or tax revenue. Bitcoin threatens the banking system's ability to extract resources by being the custodian of our assets. So they are a leech on our wealth by charging us fees for their products and custody. If we are able to free ourselves from the banking system, just take deposits. Just take deposits. Now, deposits are useful for lending. Again, we're going to come back to that in a later lecture, how a credit system can coexist with Bitcoin. But just the fact that Bitcoin eliminates some marginal demand for deposits because you just don't need them. You don't need a custodian. You just have your private key, and that's it. It threatens banks, Michael.
Mm-hmm.
Bitcoin threatens banks. It doesn't threaten governments in the way that people think it does. So you'll have to let me unpack that more. And I'm doing that in my second book, which I'm writing. It really threatens the banks. So all the attacks against Bitcoin, which I include a lot of crypto in that, a lot of the CBDC movement, it is the banks that are the most threatened by Bitcoin. It's not the governments. Now, governments act as agents on behalf of banks. We know this. We know how monetary policy goes. We know how banking lobbies have their power over politicians. And we know how Jerome Powell will pick up the phone when Jamie Dimon is calling, more so than maybe any other individual in the United States government. So I would answer your question first by suggesting that it's not the governments that are threatened, it's the banks. And then I would say that if you had an oil boom in the United States and you had a pro-oil policy, would the oil boom generate US dollar tax revenues because you would have realized profits in US dollars at some point because of increased activity broadly? Yes, you would. And I would suggest that a Bitcoin embrace in the United States, both on a mining, financial products and services, converting Bitcoin to US dollars and back to generate or to borrow, spend, invest. I would argue that a pro Bitcoin policy is additive to the US government tax base in almost every single way. Because the small fraction of law breakers that are going to be like the people that evade all sorts of exposure to the US government and go financially off the grid per se and don't contribute into the tax base, I would argue that that would be completely outweighed by the pro side, which is that it's just a commodity. And a bull market in that commodity with domestic companies working to produce it, transfer it, provide financial services for it, serve the clients would all be good. And I think that that is actually happening in the United States. We talked about that last time, a tacit acceptance from the legal standpoint with the ETF approval. I mean, that is the signal that we are the global home of Bitcoin here in the US. And we were okay being a little bit late, but BlackRock, Fidelity are now Bitcoin behemoths. JP Morgan and Coinbase, these are the four now Bitcoin behemoths. Unfortunately, for a lot of Bitcoiners, three of them are legacy companies, and one of them is on its way to becoming, a full Wall Street darling. But that's the way that the asset class has evolved. And it doesn't, just the fact that BlackRock is in doesn't change the fact that it uses private key cryptography in which you can own the number that controls your entry on the ledger, and no one else can come up with that number and just steal your money, and nobody owes it to you, and JP Morgan doesn't have your keys.
Okay, let me just counter that. I mean, I accept your argument about this is very much in the US interest to actually be a crypto or a Bitcoin power. I mean, that makes eminent sense to me. There's a lot of ways that the US government could benefit, particularly if you extend this argument out maybe to stable coins, but that is a different argument. But let me just take the question of taxation. if you've got a young population or a young society where there are not that many financial assets in existence, but there are transactions, it's relatively easy to tax transactions, be those wage payments or be those goods and services payments. That's fine. But once you get an older society where transactions are eclipsed by asset holdings, wealth taxes have to be a lot more important. Now, if I hold my wealth in a Bitcoin wallet, who knows? It's there. Okay, I can evade wealth taxes because governments have no knowledge of my holdings. Isn't that a threat?
So that's why I wanted to just put the banks against the government in terms of the enemy of Bitcoin at first, just to show you where I'm coming from in terms of who's going to try to attack Bitcoin. However, I fully accept that there is a large faction of government that wants to prevent all financial privacy, that wants to prevent you from using Bitcoin to evade wealth taxes, that wants to prevent you from using Bitcoin because it makes them less powerful as a government. It's a statement on the currency itself and the usability of a currency, which is in the government's name, even though we know banks control the issuance of it to a large part. So all of your points are valid, and all of them suggest that you will have a party. That's the way it's kind of developing now, that you'll have a political party, one of the two, that policies are aimed at preventing the free use of Bitcoin, making sure that there's a Bitcoin tax, or that there's a special tax, or that there's special disclosures that need to be done for Bitcoin. I would suggest all of that. I mean, we have evidence of it. Operation Choke Point 2.0, explicit policies from the Treasury Department, from the White House, targeting this industry. So it's not that you're wrong, Michael, that governments are a threat to Bitcoin or that they're working towards it. But governments are the agents of the people. Banks are not the agents of the people. And so Bitcoin has become politicized. And so if there are anti-Bitcoin policies, you might have people vote those people out and put in pro-Bitcoin policies. I imagine, in my optimism, that's the way that it will unfold in the United States. That's my base case based off of, I think, the way that it's gone. Despite Operation Choke Point 2.0, Bitcoin is still doing great as finding a home in the US for companies looking to build on Bitcoin services. But doesn't mean that I just think the government is going to be pro-Bitcoin. I fully recognize. And so we'll get back to your question, which is what can governments do? They can make it really difficult for companies to bank in Bitcoin and just make it, introduce special taxes or special laws that single out Bitcoin transactions for taxable purposes or for violation of privacy purposes. And those things will really challenge the use of Bitcoin in the United States, which, as the global economic leader, will be a challenge to Bitcoin's adoption and growth. I would accept that as a threat to Bitcoin's adoption path, but then just mention that, yes, Bitcoin, because it's an internet protocol, it will find its way. Just like the internet, like TCP/IP was fought against in Europe because they wanted to go with their solution. OSI was the name of the organization that had. And so Bitcoin will find its way as a value transfer mechanism because it's already globally recognized. The government can do its best to try to stop, and I think banks are doing their best to launch a tax against Bitcoin, which could include the entire cryptocurrency field potentially, launched to try to distract away from a globe that could adopt Bitcoin as a universal digital store of value.
Right. Okay. But I would, I would say in my understanding of this, the challenge that Bitcoin poses is perhaps in terms of reducing the ability of banks to do transfers. That may be clear. It would certainly reduce the cost of transfers because Bitcoin is presumably a more efficient mechanism for doing that. But then there could also be other rivals, such as the Ripple XRP as another vehicle, perhaps. But that's clearly another story. The real threat must be to the conventional asset managers because Bitcoin is, I'm seeing it as an asset here, and you've always got to buy and sell an asset to realize the value. And in other words, you can't destroy bank deposits because basically, if I sell my Bitcoin, I get a bank deposit. We're just sort of trading bank deposits, but those bank deposits are inflating in value. So the bank, in terms of banks, in terms of money supply growth or deposit growth, surely are not that effective. You're just really substituting Bitcoin for maybe an equity or whatever that may be, or another type of asset. So it's the conventional asset managers that are probably under greater threat. Is that not right?
So it's an excellent point, and I would suggest that everyone is actually under threat, but the order in which they're under threat is arguable. So if let's just take one person at a time. So let's say a young person likes Bitcoin, likes using a Bitcoin wallet, has a um, has a way to turn Bitcoin into fiat easily without having a deposit relationship at a traditional bank. That bank loses a lifetime customer, essentially, a customer that they depend on the next generation coming in. So the bank is threatened. The government's threatened, as we discussed, for a variety of reasons, especially the faction of the government that wants to infringe on your privacy and your ability to transact privately. An asset manager is threatened because if one is holding their wealth in Bitcoin, they don't need a PIMCO fund. They don't need an ETF. They don't need an RIA, a wealth advisor. So all of those people then, lose their job. And so there's a bunch of sectors of the financial industry that are going to lose customers because of Bitcoin. But think about global real estate. So all those London flats that people from, we know, Russia and various countries across the world, they come in and they hold their they hold their wealth in London flats or coastal real estate in the United States. These assets, what about the young person that comes into a large deal and with 20 million, instead of buying 4 properties, they buy one house and 15 million of Bitcoin?
Yeah.
Then the marginal demand for multi-million dollar prime real estate mansions goes down at the margin. So everybody is threatened at the margin by Bitcoin, but by how much? Are the real estate brokers of the world going to unite and try to launch an attack against Bitcoin today? I mean, I just don't think so. Are the BlackRocks and the PIMCOs going to launch an attack against Bitcoin, or are they just going to launch an ETF and try to get some of those fees? I would argue it's the latter,
Correct.
and that
Correct.
they're going to do it. So different parts of the world will react in different ways to Bitcoin. But one of Bitcoin's most powerful advantages is the fact that it's an internet protocol without a company or a government to interact with in order to use it. And because of that, Bitcoin has arguably hundreds of millions of users already. Right? So how many years until a billion people are using Bitcoin? And at the point where 1 billion people are using Bitcoin, what can anybody do to stop it or to fight it? Like, what are you doing to fight this thing?
Correct.
It's like fighting the internet.
Yeah.
Who is fighting the internet? Who is fighting our ability to turn on a computing device and go onto the HTTP network, the World Wide Web, communicate with each other there using TCP/IP via our routers, our Wi-Fi? Wi-Fi is another protocol. Universal protocols. Who's fighting to say, hey, we got to get these Wi-Fi routers out of our city or out of our country? It's just a technology that makes life better for everyone. So it's the people are the power of Bitcoin, actually. And the people are what drives the price, because the people that buy it or save in it and refuse to sell it, right? Which enforces the scarcity.
I think, a use case, a very clear use case, is the one that you just highlighted, which is basically international real estate. And you can see a compelling argument there for holding wealth in Bitcoin. That really does, I think, shine through very strongly. A compelling case. And so you've got to say that within portfolios, whatever the percentage that's in real estate or second homes or whatever the asset class you call it, that could seriously come under threat. So real estate brokers, they're the ones that are certainly going to suffer in that sort of win-lose environment. But I think, I get this. I mean, there's a win-win case for Bitcoin, but there's also a periphery that says there are going to be losers out there, as you highlight. But I think that as you run through this, the compelling case for holding Bitcoin is clearly there as an alternative means of holding wealth.
And in our next episode, we are going to get into hashing and mining so that you, Michael, can see that XRP or other cryptocurrencies, they're not a substitute. They might be used for one of these items that you describe, which is the transferability. But transferability doesn't mean anything for an asset or for money by itself. Transferability does nothing. The ownership itself and the value itself of Bitcoin are the things that underpin why it's the universally accepted. And the reason that Bitcoin has value is because it can't be copy pasted. It can't be altered from its schedule. And in our next episode, we'll get into hashing, Bitcoin's supply, and Bitcoin's mining algorithm so that you can start to see how secure the supply is. Because even Ethereum, the second place cryptocurrency by market value, has had multiple changes in its supply schedule. From whom, Michael? A group of guys, a group of men called the Ethereum Foundation and other developers in the ecosystem. Basically, people have changed it. And XRP is a company. And these things, they can all be changed. Bitcoin cannot be changed. We will teach you why. Thank you guys at home for this part 1 of teaching Michael how Bitcoin works. We didn't actually get into how Bitcoin works, but we started to understand some of the characteristics of Bitcoin and how we approach it. So I hope that you enjoyed today, Michael, and looking forward to reactions and continuing this conversation very much.
Great, Nick. Thank you. Look forward to it. Very, very interesting. I'm convinced.
Okay, guys. Thank you, guys. And we'll catch you guys next time. Teaching Bitcoin Part 2 with Michael Howell. Michael, welcome back.
Thanks, Nick. Great to be here.
We have really enjoyed teaching Bitcoin to such an incredible student. And it really is an honor for me here to be teaching someone who's my rates mentor in many ways about Bitcoin. So thank you for agreeing to do this. Part 1, we covered a little bit of the history of cryptography and introducing Bitcoin as an internet protocol first. not a company, not a counterparty. And that's the way that we want to set up Bitcoin. But we also gave the audience an introduction into whether Bitcoin is an asset or money. And we established that it is a little bit of both, but because we are experiencing a new technology, it's hard to exactly define it. But we hope, Michael, that you'll assist us as we get deeper into the entire mechanics of Bitcoin. So let's start today with public private key pairs, a little bit of cryptography, and introduce some of the underpinnings to what makes Bitcoin so special and unique. And now, when I talk about Bitcoin's cryptography, I should note, Michael, that I'm a finance practitioner. I'm not a computer scientist and definitely not an applied cryptographer. So please consider that. I have been teaching Bitcoin's cryptography from a finance perspective for many years. So I hope that this explanation will do just fine. So maybe you could just tell us your understanding of Bitcoin's cryptography if you're starting from a certain place so that I can make sure we're teaching it in the correct way.
Well, I think that I'd fess up, Nick, that I'm starting at pretty close to ground zero here. Well, I understand a little bit about the idea of public-private keys, why they're secure. A little bit about the maybe the paradoxes in terms of how to make sure that you don't get sort of doubling up on the currency. So I think we went through it a little bit last time. That was the what was that? That was the Byzantine problem. Um,
Yes.
but let's just assume that it's my knowledge is low. Put it that way.
Sure. And so the Byzantine generals problem is a communications problem in computer science. We've established that. But the cryptography behind Bitcoin, which is in part this public-private key pair relationship, is a 1970s phenomenon. And so when the cryptography field broke free of the NSA in the 1970s, the technology that allowed for the exchange of information in a private way became possible at the beginning with this public private key pair. And Bitcoin relies on the technology, but the pair of keys which allows a person to have a number, and that number is the private key. That private key can be derived offline by that person so that nobody ever has the knowledge of that number. And the odds of guessing that number, depending on the cryptography algorithm, can be up to 2 to the 256th power. So a number so large that it becomes mathematically improbable to ever guess it. Then you send that number through an equation. And that's basically the concept that makes the most sense to me as a non-cryptographer. You send it through an equation, but the equation that you send it through cannot be reverse engineered. So in a way that when we see a left side and a right side of the equation, we can know that 2 plus 6 equals 8. But if we know 8, there are technically an infinite number of solutions to the left side of the equation to make it equal to 8. So in a similar way, obviously there is highly technical computer science involved here, but the equation itself is designed in a way that you can't go backwards. So what it allows us to do in the Bitcoin context is share an address, which actually goes through two of these equations. You turn a private key into a public key and a public key into an address. You share that address. Just like I share with you my email address. You can send me information, data to my email, but you can't read my email because you don't have the password to my email account. if you send me Bitcoin to my address, that is on the other side of this equation for which I own the private key. I derived it myself. Nobody knows it. And so if we're using a real life example and we're using a hardware wallet or a smartphone wallet, for example, a Bitcoin wallet, that wallet, what it's supposed to do is randomly derive a private key for you that is done one time and stored within the hardware of the device, not on the app itself. And so in that way, we have a number that is owned by us, and on the other side is also a number, but one that we can share. And just because we share that number, nobody can reverse engineer to actually have the spendability, the power to spend that entry. And so that's what public-private key pairs do for Bitcoin, in part, is it sets up this ownership where I own the number. Then I share the hash of the number. So we'll talk about hash. Hash is when it goes through this equation. We can share the hash on the other side. And then the entire ledger, all the computers, they're called nodes, that run the Bitcoin software, they have evidence of the entries, the balances. The sum right now is north of 19 million, less than 20 million coins, will never exceed 21 million. So the sum of those 19.5 million coins are all assigned to different addresses that everyone knows. But who can spend them? Only the owners of the private keys on the other side of those addresses. And so that is the secure relationship of Bitcoin's private public key pair, but the technology goes back to the 70s. So I'll pause there and let you ask a question or two.
Well, let me draw a bizarre example, and maybe this nails it, or maybe it shows that I still don't understand. So let's think you've got a forest of 21 million trees, okay, and that represents all the Bitcoins that can ever come into existence. And then you try and locate an insect, let's say an ant, which is hiding on a leaf somewhere in one of the trees, okay? So logically, just taking one tree, you could never find that ant because you wouldn't know which, you knew which trunk to go up, but you wouldn't know which branch or which twig to actually find the ant on. But the ant could always climb back down the tree to the ground. So in other words, you've got going up the tree, you've got an infinite number of possibilities, but going down the tree, you've only got one route down. Does that make sense?
Okay, let me try to stick with the trees example. We have 21 million trees in a forest. Each one of them has an owner, and only the owner has the power to chop down that tree and sell the lumber from it. But each tree, there's only one axe that will work on each tree, like a key. Like how there's, a key opens a door, but you have to have the key. So the owners of the axes are basically doled out one at a time through the mining process. That's why mining is so important to understand, Michael. I hope that we get there today. So the mining process awards these axes, and each axe only will work with one tree.
Mm-hmm.
Right? And right now, the block reward is a little bit north of 3 Bitcoin. It started at 50 Bitcoin every block, and that's this declining supply schedule. But it's basically the awarding of the axes which is the magical process of Bitcoin. And only with each one of those axes do you have access to the lumber, which is the money, the commodity itself.
Mm-hmm.
And if you want to sell the axe itself, you can. There's a liquid market for it. But the proof of ownership of that axe can only be proven by owning this number, this private key, and doing what we call a digital signature. Mm-hmm. So you take this private number, you basically engage in a digital signature with this number, and you prove that I am the owner of the axe. So I took the ants out of your example, but I kept with the tree. So what are your thoughts?
I think that makes sense. Yeah, I think I get that.
The word hash. Okay. So the word hash is much older than Bitcoin, right? A few decades older than Bitcoin from a computer science perspective. And hash is a function. So we talked about the equation. A hash is a mathematical function. Okay? Now, the definition that Investopedia has, which is a good one, hash is a function that converts an input of letters and numbers into an encrypted output of a fixed length. So the key is that no matter what the data is on the left side, the right side will spit out something that is uniform in its structure, but can only be derived from one single number between 0 and 2 to the 256th power. So the action of hashing, when you hear the word hashing, what you have to think about is functions being performed, equations being performed. So the mining process itself is one grand hashing exercise. So that's one. And then I want you to start thinking about, if it's one grand hashing exercise, actually that's where all the energy consumption is going. It's going to perform calculations. And what are the calculations? They are these hashes. But the hashes they're not, it's the mining process that we're talking about with the energy consumption. It's not this proof of ownership process, which also takes place via hashing, but it's not the mining process. That's the proof of ownership function of Bitcoin. So in this next graphic, I have hashing as a one-way hash function. Plain text through the function and hash text on the other side. Now, the hash function that Bitcoin uses is called SHA-256. It's within a family of encryption algorithms called SHA-2, which was invented by the NSA and published in 2001, 8 years before Bitcoin software went live and 7 years before Bitcoin's paper was written. So the underlying encryption function, SHA-256, is an NSA technology.
Right. So is this like, to draw another analogy, maybe a simple one? This is like taking the works of Shakespeare. Let's say you've got the text of a play, and you're converting that into a title. So one set of text equals a hash text, which is Romeo and Juliet, something like that.
That would be one way to think about it. Yes, and that in that way, the exact series in order of characters that is in the story run through the hash function would spit out the exact and only one unique set of characters on the other side, and you could call it the title to pair one with the other. And in that way, what you could, and I'll show you actually a slide here on slide 14, which might help you. This is an example taken from a NIDIG paper, NIDIG Bitcoin Financial Services Provider, that has some great research out there. What you see, Michael, is that the first message there where it says NIDIG spits out a SHA-256 hash. That's alphanumeric there. If you add an exclamation mark to the message, you see how it completely changes the hash.
Exactly.
So one character changes the hash. And then on the right side, what it's telling you is showing you that actually the length of the message does nothing to change the length of the hash either, where the first message is just the word it. The second message is a full sentence. It still spits out the same number of characters. Okay, so that is what SHA-256 is. Now, you will go back one slide to slide 13 here. You'll see that the input, if I type hello world exclamation, hello comma world exclamation mark, that this is what it looks like in a binary output. And the hexadecimal output is what the zeros and ones are encoded to basically, the hexadecimal output is a language to interpret the binary. And so there are standards for the way that we turn the binary output into less characters, essentially. That's easier on the eye, but still is, as you can see, 64 characters. There are all sorts of families of ways that they express these alphanumeric strings. But it's, as you say, way too into the weeds here. I think that, do you have any follow-up questions on SHA-256? And let me just read you a definition from River real quick, Michael. Yep. SHA-256 is a cryptographic hash function which takes an input and produces an output of a fixed length. All SHA-256 outputs are 256 bits long. This process is deterministic, meaning a given input will produce the exact same output every time.
Right.
And it's in a family of function called Secure Hashing Algorithm Functions, NSA 2001. So yes, go ahead.
Got it. Okay. So what we're really establishing here is that Bitcoin is secure. Okay. There's these processes that are associated with security are long-standing and well-tested. And the whole structure is both robust and efficient. And that's what this is saying. And that's actually independent of Bitcoin's existence, because they've existed in their own independent sphere prior to Bitcoin, for longer. And therefore they are industry standard.
They are industry standard. It's proven technology, and it's technology that underpins a lot of what we already do from a technology and privacy and security perspective. What Bitcoin did, and why it really shocked people, because so many people were trying, and by people I mean cryptographers. Many cryptographers were trying to come up with a way that we could have decentralized digital currency, but couldn't figure out who was going to keep the ledger and how. Mm-hmm. That is the next part of the equation here. How do you figure out who is going to keep the ledger and manage the double spend, and who's double checking who's spending what? And what Satoshi Nakamoto figured out was a way to slow down time so that the whole world could come together every 10 minutes. And it's on average, because it couldn't be every 10 minutes exactly. There was no way to do that.
Okay, can I just ask you a question at this point? I mean, one of the concepts that I introduced right at the beginning was that monetary economics essentially looks at a number of puzzles or paradoxes and establishes laws through time. And One of those is Gresham's law, and another I noted was Triffin's dilemma, etc. Now, if you think about Gresham's law, which is probably the most fundamental law in monetary economics, what it essentially says is that bad money drives out good. Now, in a way, that's accurate, but in a way, it's actually inverted, because what's actually really happening is that when it says bad money drives out good, what it's saying is that people are actually hoarding the good money. That's the money that they think is the most valuable, and they're spending the clipped coins or the sort of fudged notes that people are uncertain about. So they want to get rid of the bad money. So effectively, what happens is that good money comes out of circulation. People sit on it, they hoard it, and all the bad stuff circulates. All the clipped coins in medieval times were the ones that had the highest velocity. People pass them on. Now, if you draw this analogy to Bitcoin, why is it? Why would Bitcoin satisfy this Gresham's law? Now, if there was a way that the security dimensions were ever, let's not say compromised, but surpassed by a different technology, which was even more secure, and that was embedded in a different coin, wouldn't that then, by definition, become the monetary standard, or the asset, the cryptocurrency unit of greatest value, and Bitcoin would suddenly diminish in value? Do you see where I'm going?
Yes, the short answer is that Bitcoin has the network, and that is where the value is. And the value is actually in the stored, all the hashes that have already been performed, because that's the proof of the ledger having value and having transactions and people transacting in the currency. So the past is the accumulated hashes. That's actually where Bitcoin's value is. It's not in the fact that it uses SHA. Bitcoin could the answer to your question is that Bitcoin could easily, shouldn't say easily, Bitcoin could adopt an enhanced security algorithm without allowing another new cryptocurrency to introduce that, because Bitcoin has the network effect and the stored hashes, the accumulated hashes of proof of ownership and a system that works and established value, and the network effect of hundreds of millions of people finding value in it. It's just like if we found another metal in the earth that you thought, or many people thought, was more beautiful than gold, more durable than gold, would it necessarily automatically have a higher price per gold or replace gold eventually? Is there a way? You can't say that it's theoretically impossible that we could find a new metal in the Earth's crust.
Mm-hmm.
And it is theoretically possible that it's more pleasing to the human spirit than gold is.
Mm-hmm.
It's possible. But gold also has the track record.
Right.
So how long could that take? And Bitcoin is a technology. So Bitcoin, because it is a live software that does achieve updates. How does Bitcoin achieve software updates? By consensus. There is a human element to this. There are programmers that work on improvements. Then they basically share those improvement ideas with others. And only when the entire network agrees that whatever changes are introduced won't affect 21 million, won't affect the mining algorithm, won't affect the usability, won't affect the backwards compatibility of Bitcoin, won't affect the person that mined Bitcoin in 2010, never sold, and has it on a computer that is so old that it wouldn't even be able to download the modern Bitcoin software.
Mm-hmm.
But they could still send it to an exchange because of backwards compatibility of these updates. So it's a highly scientific development process that goes on in Bitcoin. There is so much track record that you keep seeing all these new attempts. It's not just the security algorithm that it uses that makes it the best. It's that it figured out this Byzantine general's problem, which I'll show you this slide. This one also comes from River, slide 15. It's a game theory problem. How do decentralized parties arrive at consensus without a trusted party? Basically, attackers are coordinating attack, but they can only win the attack on the city if they all go at the same time. But a false messenger or a spy could come and give the message that, hey, go now, to one of the factions of the army. And if that one went by itself, it would lose, and it would, eliminate the ability of the army to win generally, because they needed all parts of the team to win. And so making sure that we all communicate on the same page on what is the latest stage of all those entries in the ledger is the key. And how did Bitcoin achieve that? Through this idea of the chain of blocks. So the word blockchain, Michael, has really been bastardized, I believe, over the last several years. The word blockchain, what it really means is a chain, so connected together, a chain of Bitcoin blocks. So I'm going to teach you what a Bitcoin block is and how they are chained together, so that you can understand the solution to the Byzantine general's problem, which is this coordination mechanism. So I'll pause there.
Okay. I haven't got a question on this really, but
then let's keep it going.
Yeah.
Okay. So Satoshi Nakamoto wrote that a purely peer-to-peer version of electronic cash would allow online payments to be sent directly from one party to another without going through a financial institution. So it's in the first sentence that this is about a non-counterparty system. The first sentence of the entire project, Michael, is about counterparty free.
Mm-hmm.
So that is the premise that we have to go on here. Digital signatures provide part of the solution, but the main benefits are lost if a trusted third party is still required to prevent double spending. So that's this coordination mechanism. So we propose a solution to the double spending problem using a peer-to-peer network. So everyone has a computer, and every block that happens is downloaded by everybody in the network all at once, and we all check it. And this all happens more or less instantaneously, right? Because it's on the internet and it's being done by high-speed computers. Once a block is found, and I'll explain to you how that process happens, but once the block is found, it is shared by the person that found it. So the miner, the computer that wins the mining reward here. So the winner of the new axe, to use your forest analogy, the winner of the new axe shares that information that I have the axe, publishes that information, not the axe itself, but the information about it, publishes it to the whole network. The whole network, all the nodes download that information. Then they verify it. So they check. Did you follow the rules? We'll talk about those rules. But the main rule being, did you take the right amount of Bitcoin from the protocol? And were the transactions that you updated the ledger with, because they do both at the same time, they win new Bitcoin and they update the ledger. That's a simultaneous process by the miner that wins the block. Did you check, are all the transactions that you included valid transactions? Meaning, did they come from the real owners of those balances? And did they spend balances that all those people actually owned? So it's a verification process, a validation, data validation process. So you hear the slogan a lot, don't trust, verify. This is that process here. Go ahead.
And what about the computational size of this? I mean, this is one of the puzzles that I've often had with crypto or blockchain.
It's very small in Bitcoin, and that is the genius part about Bitcoin. It's part of the genius about Bitcoin. The data processing of the verification is very light.
Mm-hmm.
And if you want to verify, meaning if you want to be an economic participant in Bitcoin, so think about an exchange, Michael. An exchange needs the blockchain. They need a node. They need to know, they need to verify everything that's going on, right? If they receive balances from their customers, they don't want to check some website. They want to make sure that they themselves are verifying that those balances are real. Mm-hmm. So that validation process is light. And if I'm a storefront in a country in Asia and I don't want to use a payment processor, I don't want to use a financial services provider, I just want to use my own computer, my own Bitcoin node, and I want to accept transactions from my customers, wait the 10 minutes required to verify that that was a real balance from them, and only then will I give them the product or service. And I have no exposure to any counterparty in the world. If I want to sell it for fiat, I'll have to do something there, right, with the banking system or get engaged. But if I want the Bitcoin and I don't want anybody involved, the validation process is extremely light from a data perspective. The heavy data processing is the mining. So if you want to win the new Bitcoin, you have to play the game. And that is energy intensive, computationally very intensive, and gets more so every day. So you hear about the hash rate going up. That just means there are more and more and more computers hashing, trying to win the mining reward, trying to win those new axes. So if you want to be an economic participant, it doesn't take much. You just basically need a laptop. And pretty soon, full nodes on Bitcoin phones will be more and more and more usable. But you can very easily have your phone paired to your own Bitcoin node in a way that you're the only one involved in the verification, the data validation process. So the economic participants that want financial sovereignty, the data requirements for them are light. Because of the way that the system was designed, it was designed so that anybody with a laptop could participate from a non-mining perspective. And so when we talk about Bitcoin versus other cryptocurrencies, this gives us an amazing opportunity to just establish that one of the early solutions to how we can make a better Bitcoin, Michael, was let's make the size of each block larger to fit more transactions into each block. But it's nonsensical from a computer science perspective, from the usability and light data usage that I just explained to you. Now, I'm not the expert to tell you or the network that the block should be 1 megabyte versus 2 versus 4 versus 8 megabytes. I'm not the expert. Who are the experts? The cryptographers that work on Bitcoin. So those people have, through time, established the block size and the data requirements, and they have made improvements to the way that the data gets to all the nodes. That's called block propagation. Mm-hmm. So we've had a guest on where for a couple years, her whole career was dedicated to block propagation improvements. there are Bitcoin programmers, developers working on the improvement of the protocol itself to make the software basically universal in its usage, as
Right.
universal as humanly possible and as light from the data usage as possible to make it really democratized.
Right. So the point here really is that if you're a holder of Bitcoin, the technology surrounding Bitcoin can improve over time, of which you're an ultimate beneficiary of, but it doesn't affect the value, or certainly doesn't deter from the value of the asset you're holding.
Exactly. And it's embedded into the current value because the network understands that it has won as the universal protocol for value transfer.
Right.
And so on slide 19, we have a great graphic that our designers at the Bitcoin layer created where we compare Gmail and Outlook customers to Bitcoin users using different wallets. And so if I'm using Gmail and you're using Microsoft Outlook, we can still email each other. Why?
Right.
Because they use the same protocol. It's called SMTP. It's an early 80s protocol that locked in. So ask yourself, Michael, is there going to be another protocol that replaces SMTP where all the email providers from all the time just go to the next one, or are they just going to use this one and maybe fine tune it as the decades go on?
Right.
That's how internet protocols work.
Right.
And for us to sit here and debate whether Bitcoin, the protocol, or another protocol is going to win the battle of universal value transfer would be an incredible waste of time because we actually already have about 12 years of failed attempts
Hmm.
and failed projects and failed improvement ideas to Bitcoin itself. Like I have an idea of how to fix Bitcoin. They've all failed except the ones that actually don't affect the rules enough to make the network start to disagree.
Right. Right.
The at the second the network starts to disagree, hey, I don't like that rule change, it just stopped. The idea stops because the idea already worked. You already solved the Byzantine generals problem. So I really want to get into mining today so that we can kind of uh, maybe solidify this process. But I'll pause for your questions, Michael.
Yeah. One of the other things that I noted in the last episode was that the other sort of law or observation about monetary economics was this whole concept of the Triffin dilemma. And I'll be brief on this because I know you want to move on, but let me just bring this out.
Please.
The Triffin dilemma is really something that emerged with the evolution of the US dollar through the Bretton Woods period. And it really came to a peak in the early 1970s, where you saw a clash between the commodity backing of the dollar with gold and the demands for the international monetary system for an elastic or credit based currency. Okay. And in other words, the dilemma was you couldn't have both because in order to supply dollars, the US current account deficit, or ultimately the federal deficit, had to be big, and that really surpassed the amount of gold that was backing the dollar. So that was really the issue, and it was really a dilemma or a conflict between the scarcity of commodity money and the elasticity of credit money. Now, that tension, if you like, in many ways may well have been partially, and I hesitate to say completely, solved by Bitcoin, because Bitcoin has the characteristics of commodity money with a very limited supply of 21 million, right? But it also, from what you're saying, has the elasticity of credit money, certainly in terms of its transferability through the network at low cost and in size and security. Correct?
But it's not elastic in its supply.
It's not
In
elastic in its
Yes.
supply, but it's elastic in its transferability, whereas gold or commodity money never was. That's why I say it's a partial solution.
So I would completely agree with that. That because of Bitcoin's transferability, it might have solved many of the problems that prevented gold from sufficing as the ultimate backing to the financial system, right? In its failure in the 60s, altogether failure. But the counter-cyclicality of credit expansion, fiscal policy, monetary policy, I think that it's I think that we should assume that governments will do that. And so even if Bitcoin was there and was transferable, it still wouldn't have prevented money hoarding like you were describing there, where in a deflation you hoard the money. So that was the problem in the 30s.
Right.
That was the origin of the gold seizure, FDR. The hoarding was the problem. And so if Bitcoin is the better money, it would have been hoarded also.
Correct.
And so I don't think that Bitcoin ends credit money as a phenomenon. I just think that I've thought about that as a naive way to expect the world to evolve. But I don't know if I'm right or wrong about that. I don't know if I'm being short-sighted that Bitcoin solves the need for expansionary currencies that are basically can be created and paid back for through taxes or inflation in the future.
Right. Yeah, I'm not sure it does that, but I think that that's going to occur anyway. But that in a way, supports the value of Bitcoin over the longer term, because what you've got is you've got an alternative money, or let's say you've got money, because there's a debate about whether Bitcoin is money, but Bitcoin's an asset. I think we know that. But you've got money which is being created and being forced into the system by governments, and that is basically a cyclical process. And we know that that goes too far, and governments create excess, and that's why ultimately we know the price of gold has gone up over the long term. But then with talking of Bitcoin as maybe a more convenient asset and one that's solved many of the problems that gold hasn't.
Yes, and let me give you another analogy for Bitcoin here, because we're talking about asset or money in part one. Well, asset is definitely the better way to understand Bitcoin and what it is, because it's this property, this number that you own. That is a piece of property. And so the entries on the ledger that are connected to these private keys, that ownership itself is an asset first. It is also money. It is also money because of its transferability, but it's property first. I think that is a better way to think about Bitcoin. And so imagine Bitcoin from a gold perspective or a oceanfront real estate perspective. Okay? So compare it to these things. Imagine I have a 1,000-acre property on the overlooking the Pacific Ocean, and that on that property I have agriculture that produces. Let's actually back up that example. Forget the production. Let's just say I have a 1,000-acre property with a very expansive lawn. Now I have 1,000,000 blades of grass on this lawn. Okay. I also have the house. I know that I could cut each blade of grass and sell it to the market, that it would have value if I did. Okay. I'm assuming that I could sell these blades of grass. And I'm also assuming this example that they would never grow back if I cut them. Okay. So once I've sold it, it's gone. But the brilliant thing about Bitcoin is that if you have 1,000-acre property, you can sell 0.0000001% of it, achieve liquidity, and still have the property essentially unscathed.
Mm-hmm.
And you cannot do that with prime real estate, and you can't really do it with gold bricks.
Mm-hmm.
And definitely not with any sort of divisibility of Bitcoin.
Right.
So it satisfies this property example, but it has this money-like property. It has the currency-like property. It's a commodity with currency-like properties, Michael.
Right.
And it is absolutely both, because the entries are property, but they can be transferred like a current, right? As currency is basically a current that flows. That's how we define currents and currency, is that it has to be able to flow. So Bitcoin absolutely satisfies that. So in Satoshi Nakamoto's first block, and I'm going to explain to you what blocks are. I'm here in slide 21, Michael.
Mm-hmm.
In the first block, instead of transactions, because there were none, it was the beginning of the protocol. So it's called the Genesis block, as in the genesis of the blockchain.
Mm-hmm.
And instead of transactions, there was an encoded message. It was a headline from the Times newspaper, Times of London, January 3rd, 2009, Chancellor on brink of second bailout for banks. So right in the middle of the 2008 financial crisis, second bailout for banks, a headline in a British newspaper, and that headline, the date, the name of the newspaper, were all inserted into block number 1 of Bitcoin's blockchain.
Now, is that interesting in itself? Why a British newspaper?
That is a topic for a different day, my friend.
Yeah.
It is a topic for a different day, because
It's an interesting topic.
it is.
Yeah, let's keep going.
It absolutely is. The Who is Satoshi Nakamoto is something that you probably, Michael, if you fall deep enough down this rabbit hole of Bitcoin, that you'll probably end up reading some stuff yourself in your own investigation. And it's nothing short of fascinating, because Bitcoin is fascinating. So wanting to know who created it is natural. I might point you to an episode we did several months ago, in which we look at the earliest emails between Satoshi Nakamoto and one of the first developers that he found to help him with the project. And so I'll send you that link, but
Okay.
it's definitely a fascinating topic for sure. So it is, in my opinion, of incredible importance to note that Bitcoin had what appears to be a very politically economic statement in the first data of the protocol. So every person in the world that has a Bitcoin node has this encoded message at the beginning of their blockchain. And this is a serious component to Bitcoin, and I don't want to go on this lecture without establishing it, basically. Mm-hmm. Now, we've talked about what a node is. A Bitcoin node is a computer that runs a Bitcoin implementation, so the software, and stores the entire blockchain. And what is the blockchain? It's a chain of blocks. And we are less than 1 million blocks into the blockchain, but every 210,000 blocks is when the supply introduced declines, right? So these halving events, as I'm sure you're aware of, when Bitcoin's supply that is awarded to the mining winner every block, that is cut in half. Mm-hmm. So we celebrated block number 840,000 earlier this year. which was the mining reward going from 6 1/4 Bitcoin to 3 1/8 Bitcoin every block. Started at 50, then it went to 25, then it went to 12.5 in 2016, 6 1/4 in 2020, and 3 1/8 this year. So that's the supply function. And the fascinating thing about the supply function of Bitcoin is that it wasn't present in the paper in October 2008. And then it appeared in the software in January 2009. So the supply rules, this block reward schedule for the rest of the entirety of the protocol's future, present and future, was established in that first release of the software and has never changed.
Right.
And
so if we roll on 100 years, the nodes have got the capacity to hold all these blocks with all the transactions.
Absolutely.
Without any question.
Absolutely. Okay. So this next slide here, 23, is when we're going to get into the blockchain. Okay? Now, I have 17 minutes or less, so I know I'm up against it, but we are going to explain the magic of Bitcoin to you here, because I think we have a great foundation. So the blockchain is a chain of blocks. We've established that. So now I want to tell you what is in each block. So the Genesis block has no transactions in it. The only transaction in the Genesis block is this Coinbase transaction. Now, Coinbase transaction describes the reward that we've been talking about. So the transaction is a Coinbase transaction, which is, of course, where the company Coinbase got its name from. But Coinbase is a technical term to describe this one transaction. The Coinbase transaction is a transaction in which the miner awards itself, back then, 50 Bitcoin, and right now, 3 1/8 Bitcoin. So it is a transaction. It is awarded to itself, and it can add that transaction, or it does add that transaction to the ledger when it publishes that block, as we discussed, block propagation, right? So if I win, I publish, and then everybody knows this transaction. And that's how the new supply comes into being. Is that the Coinbase transaction, which is the award, is now known to everyone, as long as I'm the winner and I'm the one publishing block number 1, block number 2, block number 3. And now I'll skip ahead real quickly. It is possible, and it does happen, that two miners find a valid block at the same time on different sides of the world. And I'll explain how that works, but theoretically it's possible, and in reality it does happen, where blocks will be found within a second of each other in different parts of the world, and then when the blocks are shared by the winners to their node neighbors, basically whoever they're connected with, that the network ends up knowing two different blocks as the next block. They both know it as valid. That's called a fork in the blockchain. It resolves by the next block, but I just want to plant the seed there to show you that this isn't some fully automatic process. It's actually a coordination mechanism. So there are periods of time in which the coordination mechanism has to take a pause to figure out what are the true balances. And that's part of the beauty and elegance of Bitcoin, is that it's slow. It's slower than you would want it to be for a fast transactional currency. But in the spirit of it being property, you have to slow it down and verify the ownership. Any thoughts, Michael?
No, I think I'm up to speed here. So
okay.
Let's keep going.
How does a miner win? That's the key I want to get to. How does a miner win the reward? Okay, so I'm going to show you here. Now, the key concept here to understand is a word called the target.
Mm-hmm.
So you have the background in a hashing algorithm. You know it's a function. You know that a Bitcoin miner now is going to assemble transactions. By the way, where are these transactions stored? They're stored in the memory of nodes. So if I send you a Bitcoin transaction, I publish that transaction to the network, and it's stored in basically a holding area in short-term memory. It's not part of the blockchain yet. It's called the mempool, technically, the memory pool. So there's a pool of transactions that are unconfirmed. I want them to be added to the entire ledger, right? So that everyone knows it, and you want it so that everyone knows that you're the new owner. I want it so that I know I've completed the transaction. But you and I will only be happy when it's in a block that everyone knows, right? Because that's the new established ownership. So our goal is to get our transaction into a block that everyone knows. So who is going to get that block added to the chain of blocks? A miner will do that. So a miner assembles transactions because that's their job. They assemble transactions from the mempool. And then they add the information from the previous block. Why? Because we have to prove, if we're a miner, that we're working on the block that everyone knows. So the last state of truth, which is the most recent block, we take that information from the block, we hash it, right? We verify it, we hash it. We put that hashed information into our current block. We put transactions. We put our own award. So look at the bottom portion here. The Coinbase transaction is the reward, the new supply to myself. Transactions 1 through N are the transactions that I'm assembling. It's usually a few thousand transactions. The timestamp, the previous block hash are portions that we get from the network and what the blockchain that we're working with. Then the number only used once there on the top left.
Mm-hmm.
The number only used once is a unique number that miners can change. And so now here is the magic of mining and how it works, Michael. So our goal is to take the information in the dark blue area, run it through a hashing algorithm, and what is it going to spit out? It's going to spit out a number, right?
Mm-hmm.
Between 0 and 2 to the 256th power. Now, how do we win the block? There's something called the difficulty target. The target is a number between 0 and 2 to the 256th, but it's a very small number. And so what does the small number do? The small number makes it so that when we hash blocks, and remember, mining, what are they doing? Hash, 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 right? So each time they hash, they get an output. That output is a number. It's usually and almost always higher than the target because the target is a small number. So the number of times you can actually hash and spit out a number less than the target is basically infinitesimal. It's incredibly rare. It's incredibly rare to the point where you would have to do it trillions and trillions and trillions and trillions of times and get lucky.
Mm-hmm.
And do it before the thousands of miners around the world that are also trying to do this first. So the difficulty target is such a small number that it makes winning blocks near impossible. And of course, it's not impossible because someone does it every 10 minutes.
Mm-hmm.
But it's rare. It's so rare that the award, the new Bitcoin, is valued today at about 200,000 US dollars, right? 3 1/8 times 60 odd thousand.
Mm-hmm.
So each one of these rewards is worth 200,000 US dollars today, but in 2009, it wasn't even worth anything because 50 Bitcoin couldn't be sold on the market for 1 cent. There was no there was no market that allowed that.
Mm-hmm.
Then somebody bought pizza and then paid somebody in Bitcoin to get the delivery to their house, and it ended up striking Bitcoin at approximately a quarter of a penny per Bitcoin. And that there were Bitcoin websites at that point where people were engaging in peer-to-peer transactions, trading Bitcoin for electronic gift cards and things like that. But over time, the mining reward and the number of Bitcoin became more valuable and more valuable to the point where this process of trying to win got incredibly competitive. You could no longer do it on a laptop. That's when Bitcoins went from CPUs to GPUs. And you would have to use graphics cards to mine Bitcoin. Now you can't even really mine Bitcoin with old computers in any effective way. You have to have application-specific chips. These are called ASICs. So the chips that are application-specific to SHA-256, because they're only designed to do what? Hash as many times as they physically can. Because each hash is an output that is most likely higher than the target. So something that's useless. So the vast majority of hashing is quote unquote useless because it doesn't yield a number that's less than the target. Therefore, the whole block cannot be published to the network as a valid block to add to the blockchain. And so when we think about bring back other cryptocurrencies, Michael, most of them don't even use a blockchain with any of this process. So when you mention cryptocurrencies that might have a company at the center that are keeping the ledger, it's so far removed from what this process is, which is really a scarcity exercise. It's a computational exercise. It's a scarcity exercise. And it has become an energy arbitrage.
Right. So in actual fact, it's entirely plausible that we'll never get to 21 million coins because it's becoming so difficult in terms of technology and so costly in terms of energy.
No, the way that the difficulty works, the target works, is that every 2 weeks, and I shouldn't say 2 weeks, it's actually a specific number of blocks. So on average, that 2,000 odd blocks, every 2 weeks, the algorithm, so that everyone's node is calculating this at all times. They look back at the last 2,000 odd blocks and they calculate, did they come every 10 minutes, every 9 minutes, every 11 minutes? If they were coming every 9 minutes or maybe even 8 minutes, what does that mean? It means that there are more and more miners attempting and finding blocks faster.
Mm-hmm.
So the target then is decreased, which makes it more difficult. So every 2 weeks, the Bitcoin algorithm adjusts its difficulty target up or down to keep the average block pace at 10 minutes. And that's why, Michael, we got a halving in 2016. We got one in 2020. We got one in 2024 because 210,000 blocks should be occurring approximately. I don't know the exact number, but I think it's about 350-ish days times 4. So really lining up with about almost exactly 4 years.
Mm-hmm.
But it's not certain that it will take that exact. It's not 210,000 times 10 minutes. It's 210,000 times about 10 minutes because every block can come 1 minute, 11 minutes, 45 minutes. If you've ever waited for that confirmation for when you're sending Bitcoin to and from whatever address, and you're just waiting for, because, thinking it's going to take 10 minutes and it's that one time a day or one time a week where it takes an hour. But it's a computational lottery process. It's a random process. But it does average out to slightly less than 10 minutes per block for the history of Bitcoin, because more and more miners join the network. So it's almost always more miners than the 10-minute limit. So we get blocks under 10 minutes, 9 minutes on average. And then the target goes down, meaning the number declines, and the difficulty of finding a valid hash that you can show to the network that, hey, I'm the winner, it makes it more and more difficult. So over time, we should keep to the exact supply schedule, which is that the end block reward will happen in approximately the year 2140, in 116 years from now, approximately. But it should be more or less on schedule because of this 2-week mechanism that we have every 2 weeks.
Okay. I'm going to have to put a wet towel around my head and think about this.
And we're going to talk next week, Michael. We look forward to your question. How about we start with all your questions? I'll go back through my slides and I'll see what else we have to extract here to make it all click.
Brilliant. Much enjoyed this, Nick.
Michael, thank you so much for joining us again for part 2 of Teaching Bitcoin. And we'll catch you guys next time for part 3. Teaching Bitcoin part 3. Michael, thanks for joining us once again.
Great pleasure, Nick. Looking forward to it once again.
So today, our goal is to discuss Bitcoin's limited supply and explain exactly why Bitcoin is limited to 21 million coins. Michael, I'm curious your thoughts after the first 2 parts of Teaching Bitcoin, some of the introduction of cryptography. What are your thoughts?
Well, I think, the two, I suppose the 2 thoughts are, one is that we kind of know that Bitcoin, by its evolution, is a decent monetary inflation hedge. But I think the other question, which I think you've answered pretty well, and you're increasingly drilling down into this, is to what extent is Bitcoin, does it have integrity, and is it a sort of safe asset for people to hold? And I think that's really the question that we're kind of tackling right now.
Wonderful. Yes. The integrity of Bitcoin, it's a great way to state the goal of somebody who's a financial researcher looking to understand this asset class. What is the integrity of the asset class? How does it compare to other things that are competing with it? So in that spirit, let's go back to our slide deck here. I want to discuss, we got to the difficulty target in the Bitcoin mining mechanics process. I wanted to introduce you that so that you could absorb the cryptographic process of Bitcoin mining. But now let's go back a little bit to pre-Bitcoin so that we can continue to drill down into why Bitcoin is special and unique and a one of a kind. I think that's also very important here. Bitcoin is a one of a kind in that it should last for a century plus, and it will outlast everything else that is competing with it. So that's my going thesis here. I want to start with Adam Back, who wrote a paper and designed a software, hash-based proof of work. Now, we talked about what the word hash means. It's a function. It's a mathematical function. And the word work here describes performing that function over and over. So Adam Back designed a system called Hashcash, which was designed to discourage spam. And the way that it was designed to discourage spam is that to send an email to a Hashcash user, the sender would have to find a hash of the email that fell within a certain range. And since the range is large, right? We talked about the potential range of the output. Since the range is so large, finding an output within a specific range would then be difficult. And so in that way, it would take many guesses. And this system imposes a cost on sending email. So in that way, it can prevent spam. Because to send me an email, you actually have to find a hash within a certain range, which will take you what? Computational power and time. And theoretically money, because your computer performing hashes theoretically has an electricity cost to it. Not even theoretically, it does. But I say theoretical in that to prevent spam, back in 2002, when this paper came out, that would have been a minimal cost, but non-zero. Now for Bitcoin, the cost to win a block is quite large, right? As the reward is also quite large, we can expect the cost to be quite large as the competition is now fierce, making it very difficult to accomplish the task of mining a Bitcoin block. So the predecessor, Michael, to Bitcoin mining in many ways is this hash-based proof of work idea called Hashcash from Dr. Adam Back, a cryptographer who's heavily involved in Bitcoin today and also was involved in a decade plus of pre-Bitcoin design ideas.
Does anyone have any notion of the cost of Bitcoin mining?
Yes. So Bitcoin mining, the cost is directly related to two variables. One of those variables is the going difficulty. So we talked about, that's why I showed you that target, so that you can see that that target is moving up and down. Because you asked the question in part 2, well, what is the speed of mining or the competition of mining due to the supply? Well, the supply is regulated by this difficulty adjustment every 2 weeks to make sure that blocks come every 10 minutes and we stay on schedule. On average, right? Because it's still it's a guessing game, it's a chance game. Bitcoin mining is a chance game. And so because it's a chance game, you can never get exactly 10 minutes apart in finding blocks. That is actually impossible because it's statistically improbable. But what is probable is that you'll vary on average from 10 minutes in any given period of time, on average. And that variance from 10 minutes is corrected by the algorithm automatically every 2,000 plus blocks, which is about 2 weeks in our human time. And that rule that is inside the protocol existed from the beginning, has never been tampered with, and is never the subject of any BIP, which stands for Bitcoin Improvement Proposal. We talked about the people that are working on improvements to the code, right? Those improvements never include, hey, let's adjust the 21 million supply. Let's adjust the halving schedule. Let's adjust the difficulty adjustment rules. Those rules are, again, this is now in theory, they're untouchable. And the reason they're untouchable is because they would directly affect the consensus that this is the network and asset that we've chosen. So another thing, Michael, you're wondering is what makes Bitcoin special? What makes it unique? And I explained to you that it's math, it's cryptography, it's a language that people can understand. And that language is now spoken in essentially every country around the world, to the point where I don't have to explain to people in South America, Africa, and Asia, not on my continent, but on other continents, I don't have to explain to them what Bitcoin is. They all understand, and the network effect is there.
Okay, so all these rules that apply to the supply of Bitcoin, they are, I mean, they're not obviously not written up somewhere, but they're accepted by the community. So, what happens if, for example, those rules were changed?
Yes,
Could they be changed?
so they are written up. It's just that they're written up in the Bitcoin code. So
Right.
remember that we have Bitcoin nodes. A Bitcoin node is a computing device that runs an implementation of this Bitcoin protocol. And remember, a protocol, the word protocol is a set of rules.
Mm-hmm.
And so the rules of the Bitcoin protocol are in the code. So when you download the Bitcoin software, in the code, it has the coding of this supply schedule, this difficulty adjustment rule, and your node is monitoring the network at all times for basically for new blocks.
Right.
And each block that each node downloads, right? Every 10 minutes on average, a new block is added to the blockchain. Each new block then goes through a verification process at every node level. And that's how we maintain the rule set and the supply rules all in one process, because they are not written down in a book that governs us or a law that governs us. They are coded into the software.
Right.
So everybody that has the software is upholding the rule set every single block. Your vote,
Right.
when you have a node and you download a block and you accept it into your chain of blocks, you are accepting that that block is valid based off of all the rules. Are all the rules followed in this block? And remember, because it's a computer and a software, it does it automatically for you. Your software
Right.
does it automatically for you instantly, as long as you are running code that you believe to be the correct implementation of Bitcoin. And that gets into the verification of software process, which is probably beyond the scope of this conversation, but verifying that your node is running the real Bitcoin software is an important thing for an economic participant in the
Right.
network.
Yeah. No, I wasn't suggesting when I said the rules weren't published. I wasn't suggesting that they didn't exist in terms of computer coding or protocol. What I was trying to infer was that they're not in a constitution or a document that you could go to the Library of Congress or the Bodleian Library in Oxford and look it up. I mean that doesn't exist, but it's obviously in the software. So the question is, who writes the software, and is there a way that maliciously that software could be changed, which would affect the integrity and maybe the confidence in Bitcoin?
Yes, so that's a great question. Who wrote the original code? Satoshi Nakamoto. Who is Satoshi Nakamoto? Again, it's a different conversation. So the fact that it came from an alias and the original supply rules have not been tampered with to date. And by tampered with, I mean changed by the developers that run the protocol, that actually run the software and are using the software. So the users themselves. The supply rules, the difficulty adjustment rules were written by Satoshi Nakamoto. They haven't changed. Your second, and the fact that it's an alias is relevant. We can get into that more if you would like. Can the rules change? So if a participant in the network wants to change some of the rules to Bitcoin, there are a couple ways that that person can go about doing it. One of the ways is to propose a change to the code publicly, share that change, and see if other people are willing to accept that change. So generally speaking, people are not ready to suggest a change to 21 million or 10-minute blocks or difficulty adjustments, because those are the core rules that everyone follows. It would change the network. It would change the emotion of what this thing is by changing the supply rules. But maliciously, somebody could award a new block with a mining reward that exceeded the current 3 1/8 Bitcoin. Let's say I just award myself 100 Bitcoin in this next block, and I actually find an output that's below the target. It's a valid hash. I propagate that block to the network. Others will download it. They'll see the Coinbase transaction is 100 Bitcoin, not 3.125, and their software will reject it. Now, then take that to the next level of maliciousness. I find the block, but then I also launch thousands of nodes around the world, mining nodes and regular nodes, in different jurisdictions around the world, different IP addresses, through VPNs, and I started propagating the incorrect block or the invalid block. And basically, this is called a 51% attack, where the idea is that somebody can take over 51% of the computers of the network and extend the blockchain in a state of untruth. But it's the truth because it's 51%. So a 51% attack, which is, I think it's basically your question, was addressed in the white paper itself, so before the code, by Satoshi. Satoshi essentially said that as long as the network can stop 51% of the CPUs taking over, the blockchain will maintain its truth and maintain its rules. Because let me also introduce here another thing about what makes Bitcoin unique. We mentioned that there are several competitors to Bitcoin. One of the ideas early was, let's make the blocks faster. And another was, let's make the blocks bigger. So let's make them arrive more quickly so that we get an updated truth more frequently than 10 minutes on average. That was one idea. And another is, let's put more transaction in each block so that more people can get their truth through every 10 minutes. Both of those ideas have failed. And I'm going to explain to you a little bit about why the timing one is so important. Because if you speed up the blocks, you run the risk of the network being in a state of chaos, because many computers know many different things. And so a 51% attack becomes less likely at this 10-minute average block for some reason. Again, this is not my discovery, but the discovery of Satoshi and the people that ran the code in the coming years that toyed with the idea of how this network worked. And for some reason, this 10-minute average block, it worked perfectly in that essentially we never have disputes on what the rules are or what the state of the ledger is. And we do have the rare 2 blocks from different parts of the world happening at the same time. But then at the point of the next block being added to either of those 2 blocks, the conflict is resolved. Everyone just downloads the longest chain. And anybody who got their transaction into the block that they thought was going to be part of the blockchain, that transaction is no longer valid. You'll start over for those 1,000 people, those, few economic participants that, fell victim to this random occurrence of a fork in the blockchain. And big deal, it gets resolved in the next 10 to 15 to 20 minutes anyway.
Right.
But the benefit here is that we don't have confusion. And the other side, your original question is about maliciousness. The opportunity for maliciousness with this slow and steady blockchain and node architecture, the opportunity for it is limited because the economic participants will reject your block if it's invalid. So I'll pause there, Michael.
Okay. This is in the realm of speculation, but let me just throw another stress test at this then. So what would happen? This is hypothetical, clearly. And let's think there is a malicious foreign government, and let's let's think of that possibly China. And China says that, it doesn't like Bitcoin, but it's going to make sure that within its domain, any computer that is running Bitcoin has to alter the protocol. So by there is, let's say, not 21 million coins in circulation, there are 25 million, and the extra 4 million is basically property of the PRC. Now, clearly they have a sizable footprint in computing power. It probably isn't anywhere near 51%, but hypothetically, are they able to control part of the network? And there would then be a division in terms of, let's say, Chinese Bitcoin and American Bitcoin.
Now, the last part of your question is interesting because they could definitely spin off their own asset.
Right.
And it would be its own network. But then that 25 million supply, all 25 million of those coins are in a separate network.
Right.
It doesn't mean that the 21 are in the current Bitcoin network. If they fork the network, it's a separate asset. And it won't trade as BTC on an exchange. It'll trade as BTC _ China because it's a different coin.
That's interesting. That's an interesting point. Yeah. Okay.
Because think about it like this. Currently, Michael, there's a let's call it a spat between BlackRock and Coinbase. Two mega participants on the institutional side of Bitcoin right now. We know that BlackRock has the largest ETF by AUM right now for Bitcoin. Mm-hmm. The ticker is IBIT. It set every ETF record this year for inflows. Shattered them, actually. And their custodian, IBIT's custodian, is Coinbase. So when we talked about those secret numbers, those private keys, the manager of the keys is Coinbase. Mm-hmm. The manager of the fund is BlackRock, in the same way that a hedge fund custodies bonds at State Street, but is the authorized signer, right, on the transactions, and actually instructs Salomon to send securities to State Street, right? But State Street gets the bonds, not the hedge fund.
Right.
Because of legal. So it's set up like that for ETFs as well. Coinbase is the custodian here. Now, BlackRock wants to know that Coinbase is keeping the keys properly, right? Of course. Now, because it's a newer technology, Bitcoin, the proof of said storage is proving to be a little bit of a hurdle, especially because Coinbase is the custodian for many other, over a half dozen of the other ETFs as well. So there are worries about commingled funds, etc. Okay, that's the backdrop here. So BlackRock has their own ability to monitor the blockchain. Coinbase has their own ability to monitor the blockchain. They're each running nodes. They're each making sure that the Bitcoin managed by their apparatus is in the correct place. So they all have nodes. And the second they see a block, that doesn't represent the rules that they all believe in. And it is a belief because anybody can change the rules of the next block. But who will download it?
Yeah.
Who will download it? And that's basically the rhetorical question to response to your proposal here is who will download it if you change the rules? If the the People's Republic of China awards themselves new Bitcoin beyond the protocol, or even if they turn on the miners, basically the most that they can do is win the new Bitcoin,
Right.
because it would be fair play. Everyone would accept it because they found the hash first. They found the hash output less than the target that was valid, awarded themselves 3.125 Bitcoin, and only included transactions in the block that every other node found as valid too, because they all followed the rules of digital signatures, signing, balances that were previously allocated to individual private keys. Basically, Michael, when everyone has a ledger, if I download a node today, I have 15 years of Bitcoin transaction history on my computer now.
Mm-hmm.
So that when a new block comes down to me and I download it, and there's a transaction in there from some random user who's spending Bitcoin for the first time in 8 years, let's say, but I myself am able to verify that transaction is valid because it was signed by a private key that I can prove controls this address,
Mm-hmm.
which has this balance. So everybody is verifying. That's the decentralized node structure of Bitcoin. And now position Bitcoin now against its competitors. Have you ever heard of Solana?
Mm-hmm.
It's the third highest cryptocurrency by market cap that doesn't include stablecoins, essentially, that doesn't include stablecoins or exchange tokens like the failed FTX or the current BNB, Binance's token, which are not true cryptocurrencies. It's a different topic. They're pseudo equity, let's just say.
Right.
Solana has frequent, because these shouldn't happen at all, but they have frequent periods in which the network goes down, so you can't get a transaction through. Now, why is that the case? Because Solana is a company,
Mm-hmm.
and that the flow of data is dependent on a company. Why has Ethereum, the second highest cryptocurrency by market cap, experienced supply rule changes? The latest one was actually Ethereum shrinking its future supply, so making it more scarce going into the future.
Mm-hmm.
Do you think that made it more valuable relative to Bitcoin or less? You would think more because of scarce, but the price actually said less, and I'll tell you why. Because the market understood that, but if you can change the rules, it's not a decentralized protocol, it's a company.
Yeah. Which is where I'm leaning in terms of these questions. But I think, I mean, you're answering the question, which sort of comes back to this, issue I raised right at the beginning, which is Gresham's law in monetary theory, which is basically saying, bad money drives out good. So you have a differentiation in quality between what look to be similar monies. So if the Chinese, for example, develop their own, or they partition the network, so they said, okay, there's a Chinese version of Bitcoin, which is only run on our systems, but we're going to give it the attraction whereby you could pay taxes to the PRC in Chinese Bitcoin, even though the protocol for supply has changed. That would then mean there were two Bitcoins in the system, as you said, but presumably the US one, I call it the US one, but the conventional one is one which is going to have higher quality. Qualities will be different and presumably have a higher value.
Absolutely. And there's a reason why Westerners don't use WeChat. It's not a network that is a universal network. It's a Chinese network.
Mm-hmm.
And so we have a unique country in China that is a global superpower with, almost a quarter of the world's population, a fifth of the world's population. So China, as it is central to your framework, has to be understood in Bitcoin's context. But
Mm-hmm.
we have a lot of experience with Chinese involvement in Bitcoin. An early miner, heavily involved in Bitcoin mining early on. There's still mining going on in China after the mining ban. We know that mining has returned to China in some ways. We also know that all of that Bitcoin that was earned by Chinese miners in the early days, some of that is still being held. We also know through this is a rabbit hole in and of itself, but Tether, the stable coin, originated out of basically the usage of Tether originated out of Hong Kong capital flight
Mm-hmm.
via Bitcoin mining, Tether, money laundry. And that is a big part of a pocket of Bitcoin's history,
Mm-hmm.
right? A pocket, as
Right.
just as the Silk Road, in the early days of Bitcoin being a currency for illicit activity on the internet, and the whole reason that the FBI seized Bitcoin in the first place, and that the U.S. government currently owns Bitcoin. So there are a lot of pockets of Bitcoin's history.
Right.
But back to China, we in the West are not using Chinese social networks because it's not where the world is.
Mm-hmm.
And so Bitcoin can be thought of in a similar way to the internet or social networks. The world is on the internet. The world is on social networks. The world is on Bitcoin. And China might and probably will try to do its own thing in many of the ways because it is a communist government. And it has a different way of doing things than the rest of the world. And that fact can coexist with Bitcoin becoming more and more like gold in its treatment, where you don't spend gold. You hoard it. You use it for reserve settlement. You use it for liquidity. If you need to derive cash quickly as a sovereign, you can do so if you have gold holdings. I say quickly,
Mm-hmm.
with a generous descriptor there. But go ahead,
Okay.
Michael. I'll pause for your questions.
Yeah, no, I've got some. I mean, I've got some questions which surround supply. They may not be appropriate now, but I mean, supply clearly is important because the demand for Bitcoin is really a function of this limited or restricted supply. I mean, that's what gives it its scarcity appeal. So, I mean, let me raise them now, and then you can see whether now is the right time to address them or not. I mean, one is, in fact, they both really pertain to the fact that Bitcoin recently has kind of traded sideways, to be generous, I suppose. And it certainly hasn't matched the recent performance of gold bullion, looking at the last maybe 3-6 months. And, what you've had through that time frame are interesting changes to the supply, prospective supply of Bitcoin. I mean, one being this case, and I don't know to what I haven't really followed it exactly, but I do know it's existed, where the German government have actually dumped on the market holdings of Bitcoin that it had, that it basically had gathered through some sort of fraud, previous fraud investigation, and then basically intercepted that and then held it and then sold it back in the market. That's one. The other is really the rise of the ETFs. and to what extent does the existence of ETFs facilitate short selling of Bitcoin indirectly?
Both excellent questions. Let's start with Germany. A one-time event in which the German government dumps Bitcoin onto the market and the price held. And that's basically the only takeaway that we have to have as Bitcoin analysts. It is the most fascinating price to follow in the world. And I I've followed financial markets for over 20 years, and Bitcoin's price action, there's just nothing like it in the rest of the world. So when we see these huge moves, 10% swings in a day, it is completely within a couple standard deviations of history, making a a mini price dump off of the back of a German, sudden supply coming to the market, being absorbed with a price dump, but then bouncing, basically finding support, finding buyers in the market. It is it's a short-term victory for the market, and then the market moves on because it didn't cascade. All the cascading that can happen. Think of November 2022. We talked about gold. We talked about liquidity. You know, the whole liquidity complex coming to a huge spike in bond volatility during that late 2022 era. Mm-hmm. And it coincided with stock market and Bitcoin weakness. The cascading, though, for Bitcoin in the headlines was all these hedge funds going under: 3AC, Voyager, Luna, Terra, and FTX, all these names that were associated with Bitcoin but weren't Bitcoin, companies with exposure to Bitcoin or on the outside of Bitcoin sphere, but affecting the whole asset class, bringing everything down, and all cascading really together. So the German situation, you just have to look at, did it cascade to this grand liquidation in which market confidence and the technicals were destroyed for the next 6 to 12 months or not? And it basically wasn't. I don't think it has. Bitcoin still trades in the mid 60s right now. Par for 6 months basically on Bitcoin with a lot of chop, but it's holding in well. And the ETFs, the short selling, it's a big concern, Michael. People are very concerned about shenanigans with paper Bitcoin in the same way that the games are played with gold, the gold price manipulation scheme that has been, uncovered through the London Bullion Association over the last decades, JP Morgan's involvement in gold's price suppression, lots of things uncovered about gold and price manipulation there. And so the concerns are valid, and I don't have a great answer to just say, hey, none of that's going to happen in Bitcoin, because we have heavy financialization of Bitcoin. And I just mentioned BlackRock basically knocking on Coinbase's door and saying, hey, we need a little bit better proof that you are not playing games.
Right.
And Bank of New York, no longer Mellon, I'm told. They've dropped that part of it, but Boney Mellon has now been granted an exception to custody Bitcoin by the US Senate. There are going to be competitors to Coinbase as the custodian for ETFs. So they're going to. So my point is that the BlackRock worries right now might be solved with some more competition, but it doesn't address paper shorting of ETFs that might limit price appreciation or suppress the Bitcoin price. A lot of Bitcoiners look to a tremendous industry veteran named Caitlin Long for her leadership on fighting the good fight on exposing Bitcoin paper price manipulation schemes, potential theoretical or real. We've had her on a couple times. She owns and runs a bank called Custodia Bank, which is in a fight with the Federal Reserve over Bitcoin custody and having a master account at the same time. And now looking at Bank of New York, Mellon being granted an exception and really saying, hey, you're picking sides. So that's something that we've covered a lot.
Yeah.
And it's a going concern, I'd say.
Yeah. But, counterparty risk among custodians is clearly something that could feed back negatively on the price of Bitcoin.
Without a doubt. And I think that with a global diversification of Bitcoin ownership, we will do better as an ecosystem to fight some of these concerns, because you have Bitcoin adhering to whether it's securities law, commodities law, or other property law in various jurisdictions should help best practices amongst global custodians. And this process is underway and has been for several years. Bitcoin exchange traded products in Canada and in Europe had a head start on all the Bitcoin ETFs in the United States. And the ETPs in Canada had a head start on property law and custodial relationships. And Fidelity had launched their if I'm not incorrect, Fidelity launched their Canadian product months before their US product. And Fidelity is the only US ETF that has their own custodian, which is their own basically branch of the headquartered Fidelity Digital Assets, which I'm sure you're aware of.
Yeah.
What are your thoughts here, Michael?
Well, I think you've answered a lot of those questions. I mean, we can't really quantify the extent to which there is short selling, maybe of ETFs, and to what extent that has an effect on the Bitcoin price. But it must be there. Presumably, that's actually, that maybe is the wrong statement. I was going to say presumably that was an initial event, maybe caused by some skepticism about ETFs or Bitcoin that may go away in the future. I suppose it'll always be short selling. That's the reality, but it's not really going to materially affect the long-term supply or lack of supply of Bitcoin.
The way that I see it is the increase of financialization has a power over Bitcoin from the long side more than the short side, because a lot of what you teach, which is that a strong collateral base gives the financial sector the ability to create money. And the money creation itself drives asset prices.
Right.
And so if Bitcoin futures, Bitcoin ETFs, and options on Bitcoin ETFs are all live products, then anybody with access to leverage and a margin account can get involved to the long side. And in the ETF world, they do have to physically settle, despite whatever games might be played or are attempted to be played. This is happening all around the world, where the physical settlement of Bitcoin, and when I say physical, I mean the coins sent to an address, that transaction included in a valid block, downloaded by the entire network, and basically becomes past history. And each block that passes, remember we talked about forks. A block right now should, all exchanges that are doing their due diligence and proper best practices, they wait 3 to 6 blocks until they let you sell. If you send, they wait, and then they'll say, oh, enough blocks have passed. Your funds are valid to trade. Your Bitcoin is valid to trade.
Right.
But once an hour has passed, that's now, hammered into stone. And it's not even stone. It is permanence, because it's digital permanence on every node in the world.
Right, right. I think I think these are really interesting questions because, as you rightly say, collateral in the international monetary system is really important. History shows, and I'm talking here of long-term history, that the most important price in financial markets is always the price of the dominant economy's debt. So, in the 19th century, it was British consols. Now it's U.S. treasuries. But in a multipolar world where government debt, the integrity of government debt must be questioned because of increasing monetization, you're then going to gravitate towards a new form of collateral, and maybe that collateral is Bitcoin. So maybe that is the future collateral that we've got to be thinking about because it does have integrity, as we've been arguing
It
and hopefully
is
proven.
it is pristine collateral from so many qualitative angles. Because if you think about testing the purity of Bitcoin, testing the purity of gold, and testing the purity of US treasuries, they all have pros and cons, but testing the purity of Bitcoin is the most transparent of all three of those assets by such a wide margin. You mentioned the increasing monetization of US treasuries, increasing monetization and supply, and no limit in the increase in supply. All of those things happen. Gold answers some of the increase in supply, but it is a logistical nightmare to move the metal and to actually test it all.
Yeah,
Right?
yeah.
When we think about the differences between Bitcoin and gold when it comes to verification of that process. And so in the digital world that we live in, Bitcoin represents the most pristine collateral that you can imagine because it's not tied to a government. So it doesn't have those risks, and it's not tied to something physical. It's numerical, which can be
Mm,
transmitted via computers and can still
right,
act as physical because the numbers themselves are rare.
right, right. Right. Understood. Yeah. I mean, if you take another example, um, Bitcoin has a ceiling on 21 million supply, as we've been discussing. The U.S. debt, U.S. government debt, has a debt ceiling. There's no debt ceiling at the moment. It's going to be reimposed January 2nd, 2025. But then we know that debt ceiling is going to ratchet higher and higher over the years. Because the supply of US debt is not fixed, despite the notional debt ceiling. That debt ceiling is a floating ceiling that only floats upwards. But if you look at the data since year 2000, the outstanding stock of US debt, which is in the sort of 36, 37 trillion right now, has increased by eightfold. There are very few assets that have gone up 8 times over that period, but gold is one. And I would venture, obviously, Bitcoin, but that's an unfair association, is another one.
Yes, the supply of US treasuries won't come down because that's a political phenomenon.
Right, right.
And we have a lot of evidence that the way out of that type of debt load is
Mm-hmm,
not going to be a contraction of it and a physical pay down,
mm-hmm,
right, through the liquidation
right.
of assets. Michael, I want to go to slide 37 because we are talking about the limits of supply. So I want to show you a little graphic here which details the supply function, the programmatic unfolding of that supply for Bitcoin, and to just give you an idea of the certainty that we have. Now, this little table here it only goes out 36 years into the future.
Mm-hmm.
Whereas Bitcoin's supply schedule is scheduled to continue to increase until the year 2140. So in 116 years from now. But you can look at the 2024 line, which is era 5. We've gone through 4 halvings. The last one was at block 840,000, as you can see there. And at block 840,000, we had reached 19,687,500 Bitcoin.
Right.
And 96%, 96+% of the Bitcoin to ever be created. And so what that basically means is that the new Bitcoin coming into existence now are such a small fraction of the existing Bitcoin that the fight over those additional Bitcoin becomes so fierce. And that is itself baked into this mining process. So there's really this virtuous cycle in Bitcoin in which the network started to gain value, which attracted miners to the network so that miners could win the reward and sell it for profit. But the increased miners increased the difficulty. And the increased difficulty prevented what? It prevented the threat of 51% attacks, which was one of your first questions here.
Mm-hmm.
What about the maliciousness? Well, the more miners that you have in more pockets of the world, the less likely there is to be a 51% attack. And if that is less likely, what becomes more valuable? The underlying coin itself.
Right.
Because it has more security, more decentralization, and then that attracts a higher price, which attracts more miners.
Right.
And you do cycle up and down with Bitcoin. You can look at slide 40 here. Slide 40 is an unbelievably informative representation of Bitcoin and its history. This is a concept called HODL waves. HODL being the word hold, misspelled per the Bitcoin meme culture, and waves because Bitcoin, as it cycles, experiences waves of old coins being sold. So think about it like this. If you were an early adopter and you mined Bitcoin when you had your laptop on,
Mm-hmm.
and remember I mentioned that Satoshi said CPUs, as long as 51% of CPUs aren't malicious, that was when you could mine Bitcoin on your laptop. But CPUs can't get the job done anymore. They just can't compete. That's why we have specialized hardware for Bitcoin mining now.
Mm-hmm.
If you were an original miner of Bitcoin and you saw Bitcoin spike to $1,000 in late 2013, and you were sitting on $500,000 worth of Bitcoin from something that you thought was worth zero when you did it, or basically
Mm-hmm.
something that was worth maybe, one pizza is now worth one house.
Mm-hmm.
You're likely to see, or you're more likely to see, a liquidation in that type of parabolic price move from those original holders. And so then what you see in these colors are waves of activity in which the age of coins shrinks. And by age, I mean how long had it been since those coins moved on the blockchain.
Right.
Because if I'm holding and I send it to the exchange getting ready to sell, the coin has now moved. It has a new age. That age is 0, as opposed to that age being 2 years or 3 years. So with the age of coins moving through the system, we're able to measure something behaviorally so interesting. Imagine being able to watch the age of shares of individual stocks being traded hands. We would derive information from that.
So this is really a measure of the velocity of Bitcoin.
In a way, yes. Velocity traditionally, right, is going to be based off of the number of transactions.
Yeah, well,
and
this is
this
the
and the
turnover.
and the size. This is the number of transactions aren't changing, but what is changing is the age of those underlying units that are moving.
Right. So in fixed income speak, basically you're moving from off the run to on the run. More and more of the coins are on the run.
That's a wonderful way to put it. When coins leave the off the run and become on the run, so in fixed income terms, if you're a corporate and you do a fresh issue and then you do a buyback or a call of everything that's outstanding, that's near maturity, a cleanup call basically. That type of activity is it takes place during Bitcoin's parabolic moves,
Mhm.
where you see a whole flurry of activity of coins that haven't moved in a long time. And then in the interim periods, we see holding, or as Bitcoiners call it, hodling. They hodl and hodl and hodl because they understand behaviorally that at some point there will be a squeeze on available supply if they create it themselves by not sending coins to the exchange. Because in a parabolic move, you get retail, they come in, they buy, and the authorized participants go to source, and the coins are running out. The price shoots up. And then how does the
Right.
price come back down? The long-term hodlers send their coins to the exchange, and they liquidate at these very expensive valuations. And why are they expensive? Because they're relative to the on-chain cost basis of those original holders, which in Bitcoin speak is called realized price, or the realized value. It is it's basically a sum of an aggregated sum of coins that have moved and their US dollar price.
Right.
Coins when they have last moved, apologies. Coins when they have last moved and the dollar price at which they last moved. So when we overlay Bitcoin's price to its realized price, we can say that realized price goes in a very steady stepwise function, but price obviously chops around all over the place. And when price falls below realized price, it never stays there for an extended period of time, as that's basically the network at trading at a loss or holding at a loss. And the general growth path of Bitcoin brings, the staunchest believers back into the market, and they
Right.
buy below realized price because they
So
see
it's a
value.
measure of marginal supply.
Yes.
Okay.
It does measure marginal supply because the age itself, the relative price to realized price, measures the profitability.
Mm-hmm.
And profitability will motivate marginal
Sure.
supply. Absolutely correct. I've never described it like that, but the MVRV ratio, which is our market price to realized price ratio, represents our best Bitcoin valuation metric that we have, because it
Okay.
represents the willingness to sell, because of profitability. And that willingness to sell due to profitability will directly inform marginal supply.
Right. Got it.
Now, Michael, I want to guide you through here on slide 50, if you'll jump ahead for me. We didn't get into every bit of the cryptographic details here, and I'm not sure that we needed to, but I'm happy to, continue going over this when we meet again for part 4 here. But I want to guide you through the lifestyle of the life cycle of a Bitcoin transaction here, so that you can follow a transaction from origination to blockchain and see if you are following the mining process and the transaction process as one process, because they are.
Right.
Okay? So I send you Bitcoin. So I have a wallet open and I sign a transaction, meaning I authorize every node in the world. I authorize every node to take this balance that was once mine and sign it over to a new address that you've created for me, that you generated yourself, that I don't know. And remember, you hashed it and hashed it again to give me the address so you could share a piece of information with me. But only you have the private key, so that if you want to spend it one day, only you can.
Right.
Okay? So I sign this transaction, and it goes through multiple steps before being added to the blockchain. Okay? So I broadcast that transaction to the entire Bitcoin network. It's not part of the blockchain yet. It goes into a suspense account, to use a financial term. It's called the mempool. Miners then aggregate new transactions together into a block, and they look at the mempool and grab transactions. Now, I will also have attached a small fee, which is denominated in Bitcoin, a fraction of a Bitcoin. I will attach a small fee to my transaction as a signal to miners, hey, please include my transaction in your block. Because if you win the block, you'll get to keep the tail.
Right.
Okay?
And that's a fixed percentage.
No, it is not fixed, it's variable, and it is completely up to the sender.
Right.
So the sender can assign priority with a price signal. Low priority, low fee. High priority, high fee. Next block urgency, high fee. Not next block urgency, can wait a few blocks, fall to the bottom of the line, low fee.
Right.
So
but there are conventions here.
There are conventions, there are wallet conventions. Each wallet provider will have its own convention. There are conventions. But again, these are things, Michael, that are in the sphere of BIPs, these improvement proposals. People working on all sorts of improvements, like how to attach miner fees. One of them was, hey, if I attach a fee and I realize that it's too low and it's going to take me a day, I want to bump the fee up, but I don't want to cancel my transaction. That takes technical workthroughs and coding. They're working on all of these things. And by they, I mean Bitcoin developers that do not work for a single company, that are more or less decentralized, might be funded by a few companies, might be funded by open funding, or might not be funded at all, and are all working together.
Okay.
And then nobody is saying yes or no. They propose and then mass accept or mass reject, as a consensus. And even that has disputes. I'd love to get into the 2017 dispute with you at some point if we could, because there's a lot of history to unpack there. So number 3, once the miners have aggregated their new transactions, then they start to find a proof of work. And that's the hashing. Right? So performing the function. When proof of work is found, it means that the output of their hashed block is less than the target, which is rare. It's very rare. So when they do that, they broadcast the block to the network. Then the network participants see the block, they download it, and then they check, are the transactions valid? Is the Coinbase transaction valid? Did it come from the most recent block that I also know? So did it include a hash of my most recent block so that I know it's using the current state? All of that is done automatically. Then miners acknowledge the block as valid by moving to work to the next block. So not just the economic participants, but the miners too, they all download a valid block, and then they see, oh, this is correct. Okay, I'm going to start over, and now I'm going to use this new block as my previous block hash, and I'm going to start assembling a new block.
Right.
And that's how Bitcoin transactions are added to the Bitcoin blockchain. And it's also how new Bitcoin comes into supply, because in each block, there is a Coinbase transaction which awards new Bitcoin to the miner per an exact supply schedule that is following its timing. Basically, in that every 10 minutes, we get a new block, and every 4 years on average, and it's 210,000 blocks, not 4 years. And that every 210,000 blocks, the mining reward, the Coinbase transaction, will half in its quantity of Bitcoin awarded to each miner. And so the supply, the programmatic supply is held, it's upheld every 10 minutes. It's upheld every block.
Right.
Even though the halvings happen every 210,000 blocks,
Right.
the rules are followed every block, because every block represents the rules.
So once you get to 21 million coins, miners can still make money because they're validating transactions. And
Of course.
they're clipping each time you get a transaction with a small amount of Bitcoin.
Absolutely.
They're getting paid out of the existing pool.
Absolutely correct.
Right. Got it.
It's funny how many people think that Bitcoin running out of new supply in 2140 will all of a sudden just eliminate miner incentives, but that's not the case. If we stopped finding gold in the Earth's crust, would we stop using gold, or would it still be valuable?
Yeah. Well, the answer is obviously more valuable, but there we are.
The answer is obviously more valuable. Michael, any last questions here? We've gone.
No,
I think
I've got it. I think that's it's becoming more and more clear. I think this whole this whole episode, this whole journey. So that's great.
Okay, excellent. Well, I'm going to design an excellent part for you to go more into the financial side. We'll talk about realized price, our MVRV, and I want to know your questions about Bitcoin's valuation, where you think Bitcoin finds a role in our monetary future, and how it compares to gold, all of that. So we look forward to our next meeting.
Yeah. And I think some of the metrics that you use as a Bitcoin analyst would be useful to understand more fully. Which are the key metrics?
Absolutely, we will do that. We'll start with realized price, and we'll go from there.
Brilliant. Look forward to it, Nick. Thank you.
With Michael Howell, I'm Nick Bhatia. We'll catch you guys next time here at the Bitcoin Layer.